You make the decision to move to the Bahamas of all the options out there?
We've been looking at the Bahamas for a while. They're one of the first countries to roll out any comprehensive regulation for cryptocurrencies, which we think is extremely important for the space and a really positive sign.
Welcome back to the European market open. A minute to go until the start of cash equity trading. I'm Danny Berger in London alongside Tom McKenzie.
And here are your top stories. The global sell-off deepens. The S&P 500 closes at its lowest since July amid concerns about surging prices. Asian stocks fall as another Chinese property developer misses a bond payment. Facebook suffers a devastating outage across its most popular platforms. Millions flock to competitors, and Mark Zuckerberg's personal fortune plunges by $6 billion. And oil rallies to its highest since 2014 after OPEC Plus maintains gradual supply increases despite the energy crunch.
With all that in mind, let's take a look at the futures. About 10 seconds to go until your cash equity trading. Markets are higher when it comes to across these continents, up by just about 0.2% though, so not huge gains, but we're just starting to get this market opening up. Tom, how is it shaping up so far?
Yeah, not making up, as you say, the futures, not making up for the gains that we saw, the losses that we saw yesterday, of course, those concerns about the technology sector and what we saw in terms of Wall Street, the NASDAQ closing down more than 2%. We wanted to look at the individual indexes to give you a sense of how things are opening up, of course, across Europe, given what the futures were showing. The question marks about growth and about inflation, of course. Deutsche Bank saying that demand, or at least from their clients, to talk and discuss and break down the stagflationary risks that are now here is increasingly part of the conversation. You're seeing South Korea, by the way, that was in correction. Hong Kong tech stocks, Chinese tech stocks in correction. Japan closing on a correction as well. That September record that you saw on the Nikkei being taken out by about 10%. That didn't last long around the change in politics. Let's have a look at how the sectors are faring then today and see if we can switch on the board. Of course, it was energy that was at top of the pile yesterday on the back of those higher oil prices. OPEC Plus, we know, coming out not changing their stance in terms of these gradual increases in production, not riding to the rescue of those who want to see a softer oil price. Concerns again about how that plays into the growth picture. And at the bottom of the list yesterday was technology. So here's how things stand right now. Energy is currently unchanged after the gains of yesterday. The basic resources are up 0.1%. Technology is gaining 0.5%. So maybe a little bit of dip buying here. And our previous guest in the previous hour, Newton, saying, look, if you have a 5-month view on the markets, you want to be buying cyclicals, you want to be buying the value stocks. When you have a 5 to 10 year view, you should look still at growth and technology names. Travel and leisure, by the way, gaining 0.8%, more than 2 points. That is how things stand in the first minute or so, 2 minutes of the trading session here in Europe. Danny.
Yeah, really struggling to get any direction from energy this morning. We are seeing equity markets open up broadly to the upside. And what really takes me back to this tech question is what Bank of America said last week, that it's this Pavlovian buy the dip type of response that we're seeing. Well, will we see that in tech? We might be seeing some in this futures trading session and in Europe. But here's where tech stands at the moment. We are heading to a correction in those large cap FANG stocks. It's a lot of worries weighing on this, be it long long duration looking less attractive with higher rates, be it regulation concerns, be it just a simple outage yesterday where people couldn't use WhatsApp or check their Instagram. Either way, is this a sector you want to be playing in right now? Let's take that question to our guest host for this half hour. That's Luis Dudley, Portfolio Manager for Global Equities at Hermes Fund Managers. Thanks so much for joining us this morning. So are you a buyer of the dip on this tech sell-off?
So we're actually not. I think you mentioned in terms of it depends a lot on your time horizon. So we do still have a positive outlook for the year end, but there's definitely some near-term volatility corrections. You know, we're going to have earnings. We're expecting inflation to be a big concern. Interest rates also really hurting those tech, those growth names as well.
How sticky do you think inflation is at this point? In terms of break-evens, it's suggesting that these are becoming more entrenched, the views on higher inflation. Are we past this transitory view that the central banks keep pushing? Do we have to make a call on this soon?
I think it's still transitory, but definitely longer term. So we're expecting it to stay through 2022. It's also maybe coming in a bit stronger than people expected. In some cases, even double. Also, companies are being hit from multiple sides. So definitely kind of the wage inflation as well as on the energy pricing as well. And, you know, maybe energy can keep going from here. And so that's going to continue to impact those names. We're still seeing scarcity in terms of freight. That's going to continue to push that. We've also got the supply chain constraints, which are continuing to hit coming from China as we see some shutdowns in manufacturing. We've had some weak numbers in the last week in terms of those Chinese manufacturing numbers. So expecting that some of those supply chain constraints not going to ease in the near term. So therefore, definitely inflation sticking around for 2022. But then expected to kind of hit off and definitely not expected to rally through kind of out of control ranges like going back to the 70s.
Well, in terms of those costs picking up and the effect that it has on corporations, we've seen earnings upgrades, the pace of which starting to slow down as we enter into the third quarter. You have analysts flagging this as a risk and why earnings might not look as strong. How concerning is this earnings picture to you when we have these margin pressures really weighing on companies?
So we've gone through a couple of earnings that have been really, really strong. We've obviously had, you know, last year being so weak. So the year-on-year numbers have been pretty good for a lot of companies. So that is coming down, but we are still seeing some growth. So it's a case of kind of the delta change is coming down, but we're still seeing that absolute number coming up. At the same time, you know, there's a lot of concern for the top line not being able to grow looking into 2022 as strongly as we expected. So kind of those global growth numbers not being as good, particularly when looking within Asia, which is, you know, one of those big growth drivers globally, and that's going to hit across the world.
Louise, what's your view on Europe? Of course, there's a heavy focus or a heavy tilt towards cyclicals and value in this part of the world. Is that an area where you want to be increasing exposure?
So, you know, definitely, you know, when looking US versus Europe, Europe definitely has more of that value exposure, even from a sector perspective. So even if you're going to take a market view, you know, an index view, you're going to get more value from Europe just because of that sector exposure, the US being so heavy within technology. So to a certain extent, you get that. You know, the other area that we always look at in terms of value is Japan, a strong industrial sector focus as well. So both Europe and Japan at the moment certainly haven't rallied as strongly as the US, and definitely areas and pockets of attractive names within that.
It is interesting to see the contours that this value rotation is starting to take, just because what we're seeing outperform are sectors like energy. You're not necessarily seeing materials do well. It's more energy and financials. What does it tell you that we're not having a wider breadth of that value rotation at the moment?
So I think materials have been so strong through the year. Definitely we've seen kind of some of those names come off, some of those individual commodities coming down in terms of prices. And right now we're really seeing kind of the lower quality names kind of doing well, and interest rates just so sensitive. So obviously the financials really benefiting from that.
Louise, do you have a view on the UK equity space, given the challenges that this country is facing? It's the Tory Party conference this week in Manchester. They're trying to look ahead to reskilling the workforce, but you have some like Gavakol coming out with a note suggesting that you could even see a recession in the UK next year. They're flagging a potential policy misstep. How do you view the UK equity space?
Yeah, so I mean, UK is generally looking actually a bit stronger than the rest of Europe in terms of growth expectations, but at the same time, it suffers a little bit from that sector split. So we've had a lot of really good performance from those materials names, and so therefore maybe within the UK, looking more within the small cap space, definitely seeing continued stimulus coming through as well. So that's maybe more where we're focusing at the moment.
So that's where you're focusing. Heading here into the year end, what do you want to avoid?
So at the moment, continuing to ensure that we're really kind of looking into 2022. So, actually capitalizing. So not so much buying the debt, but definitely taking on names when they do become dislocated in terms of their valuation, where we do have that longer term view, because I think, definitely looking into year end, we've got the COP coming in. We've obviously got the infrastructure bill coming through. Some of that ongoing spending, some of that longer term value drivers are going to come through. So sustainability continues to be a really big driver going into next year. Some of that innovation within new technologies as well. Within financials, it's more of the kind of technology financials that, alternative payment systems, some of those names, continue to see really, really strong growth. Some of the trends that we saw coming through from last year in terms of kind of work from home, technology, online shopping, they're going to continue to be really strong. There's logistic names within real estate as well. So that's what we're thinking into 2022.
Louise Dudley, Portfolio Manager for Global Equities at Hermes Fund Managers, stays with us. We'll get your views on China next. Coming up, more difficulties for that country's property sector. That's after Fantasia fell into crisis on Monday after failing to repay a nearly $206 million bond. More on that next and the risks of further contagion. This is Bloomberg.
Who are U.S. Open tennis champion Emma Raducanu's three dream dinner guests?
Daniel Ricciardo, Michael Jordan, and then Tom Keane from Bloomberg.
She understands you.
Funny and very understandable.
I am reading in on tennis like nobody.
Yeah. Champion approved Bloomberg surveillance. Mornings on Bloomberg Television and Radio.
Mistakes you've made or failures that you can talk about so that people could feel you're not just a superhuman.
People ask that question as if the only challenge is at work. Challenges come in a lot of different packages.
Welcome back to the Open. We are 12 minutes into the European trading day. Stocks across Europe gaining 0.5%. In terms of the indexes, the outstanding indexes, the FTSE 100 gaining 0.6%. The DAX, by the way, up 0.4%. Let's switch focus to some of the individual movers. The demand for sausage rolls and pasties in the UK remains strong. That's if you look at Greggs. You can see gains there in the share price of that company of more than 4%. They expect financial performance to be ahead of previous expectations, so raising their forecasts on the back of strong demand for their sandwiches and sausage rolls. Danny.
All right, this is definitely making me want a second breakfast. But in the meantime, I'm also looking at EDF. That's, of course, the French energy company. Nuclear power is something that they're very much so involved with. And considering the energy crisis, there's been this move to phase out gas use in Europe and the UK, go towards nuclear. So that's been helping the company. But we also had Morgan Stanley upgrade the shares today as well.
Interesting. In terms of a stock that's not performing so well, we're going to have a look at GN. This is a Danish company. It makes essentially hearing devices, and they said they've cut their financial outlook for their hearing aid units, citing delays in product development. That stock down more than 4%. Danny.
All right, so those are your stocks on the move. The broader index up about 0.5% this morning. Now let's get over to the Bloomberg Business Flash. Here's Laura Wright. Hi, Laura.
Hi, Danny. Veteran hedge fund manager Ken Griffin has a warning for younger employees. You're risking possible career advancement by continuing to work remotely. The Citadel chief says working outside the office also hampers innovation. He thinks working from home could cost us dearly over the next few decades. Chipmaker Global Foundries has filed for an IPO. It's looking to capitalize on the chip boom amid a severe shortage of semiconductors. The firm is owned by the investment arm of the Abu Dhabi government called Mubadala. Bloomberg previously reported it was looking to value the business at around $30 billion. JP Morgan is banning business travel and in-person meetings for employees who are not vaccinated. It also says the unvaccinated will face higher payroll deductions to cover the cost of testing and health insurance. Wall Street banks have been adjusting their rules as they continue to push to bring staff back to the office. That's the Bloomberg Business Flash. Tom, Danny.
Laura, thank you. Okay, another Chinese developer fell into crisis on Monday after failing to repay a nearly $206 million bond. Fantasia, what a name, is adding to the strains of the nation's heavily leveraged property firms following industry giant Evergrande's debt woes. Bloomberg's Rebecca June-Wilkins has been following all the twists and turns of this story. Rebecca, how are we seeing stress then manifest across China's credit market? How bad is it right now?
Well, we're seeing a really rather brutal sell-off in China high-yield junk bonds today. The kind of broader market down about 5 cents on the dollar. Single B-rated names down as much as 10 cents. So that's sort of the worst performance since 2013 at least. And I think the danger here is that we're really seeing a kind of shift in tone after this sort of surprise missed payment by Fantasia. The expectation was actually that they were going to make this payment, albeit face other financial struggles with its next maturities. And the problem, of course, is that this becomes a kind of self-fulfilling prophecy. If borrowing costs soar to levels at which these weaker companies cannot refinance their debt, of course, it becomes inevitable that they will struggle to repay that and that we will see more defaults. Of course, the broader landscape here is against that. This is all happening against this backdrop of this kind of imminent or, potential restructuring at Evergrande Group, which people are so worried about here. Very little clarity with exactly how that's going to play out, and of course with this potential sale by Popson, another property developer, of Evergrande property unit stake sale. So there's a lot of uncertainty here, and bondholders and investors are looking very, very closely at some of these kind of weaker companies and their weaker cash flows.
All right, Rebecca, thanks so much for staying on top of this story for us. That's Bloomberg's Rebecca Chung-Wilkins. Louise Dudley, portfolio manager at Global Equities at Hermes Fund Managers, is still with us. So, Louise, does it make sense that the entirety of the Asia high-yield bond space sells off in sympathy with what's happening, not just at Evergrande, but now Fantasia as well?
So I think definitely, and up until yesterday, there was definitely a feeling that things had been contained. We were getting positive sounds in terms of the fact that it wasn't going to leak into the other sectors, that the banks definitely had it under control. Now, obviously, this brings up the risk somewhat. although our view is still that it can still be contained. We do worry about how it spreads into other sectors, whether it leads to broader Chinese consumer weakness. We've obviously, as I mentioned earlier, had those kind of weaker numbers coming through on the manufacturing side. If that starts to come through on the consumer side, and then we get kind of greater contagion across those other sectors, then it's going to continue to weaken that outlook, not just kind of in the near term, but also longer term as well.
Louise, is there an opportunity to discriminate as an investor between those companies that are heavily leveraged and don't meet Beijing's 3 red lines requirements, and those that are better capitalized and have a big footprint in some of these major cities in China? Is there an opportunity that's opening up, or is it still too early?
I think definitely within kind of real estate financials, we're saying, it's still too early. We're still very cautious about what regulation might come in, what other movements might be happening behind the scene. So we're looking more actually towards the kind of the staples names, some of those more consumer kind of standard, as you say, kind of low levered, but also, actually have strong business models that are going to keep growing, are more skewed to the bottom consumer, and actually, although they are being impacted by some of these inflation numbers, actually continue to do quite well. So definitely looking to kind of risk off within that market. Certainly at the moment where there's still a lot of questions, and as I mentioned, regulation within China, very much an unknown, and almost anything could happen. So not willing to kind of go in there yet.
You mentioned some of the inflation numbers. In general, what do you make of the data coming out of the region? Are you concerned about a slowing pace of growth from China?
Yes, and I think, there's lots of discussion around the energy crunch as well. China very much skewed in terms of real estate, financials, but also kind of materials on those energy names. And we're seeing as well, those companies being asked to step in and buy at prices that, they probably don't really want to, and securing those supplies. So that's going to hit them as well. The delta that we have in terms of the change within China, and obviously the size of that economy is so huge, and the visibility that we have is not very great. So yeah, still a lot of question marks there, and quite concerned about the inflation and how quickly that could ramp up across the regions within China.
Louise Dudley, solid insights this morning. Thank you for joining us. Portfolio manager for global equities at Hermes Fund Managers. Okay, coming up, Facebook's Mark Zuckerberg apologizes for a global service outage that kept its social media apps offline for much of Monday. We'll look at the fallout from that next. This is Bloomberg.
Essa população é uma população importante, é uma população que frequenta a escola também, né? Então é importante que eles também estejam protegidos para o coronavírus, evitando essa transmissão.
Eu estava esperando muito por essa vacina. Desde o ano passado eu estava torcendo logo para poder minha vida logo voltar ao normal, que eu quero logo voltar para a escola, eu quero voltar a sair com meus amigos, eu quero sair, eu quero voltar à minha vida normal. A dose foi toda administrada.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
we've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
I support the new framework.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio. Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, Early Edition. Weekday mornings on Bloomberg Television.
Welcome back to the Open. We're about 23 minutes into your European trading day. Mostly some solid rises here. We're looking at EDF at the bottom of your screen there. That's the French energy nuclear company. That's really where we're seeing a lot of these gains, these more sort of macro stories about energy helping to push us higher here. But elsewhere, it's about a 0.5% gain for your Euro Stock 600. DAX, CAC, Aron, both of those pushing higher as well. Let's stick with the tech story, though, because obviously that was the source of a lot of pain yesterday, where Facebook's Mark Zuckerberg has apologized for a global service outage that kept its social media apps offline for much of Monday. For more on this story, we're joined by Bloomberg's Laura Wright. So Laura, bring us up to date. What happened yesterday that meant I, for hours, was not able to send a single WhatsApp?
Yeah, I experienced the same panic, Danny. Roger Hearing on radio says it was like being sent back to the 70s. And this is because a network configuration led to a global outage. 2.7 billion users across the platforms, Facebook, Messenger, Instagram, and WhatsApp, unable to access them for over 6 hours. Even Facebook's own internal systems were down. As you mentioned, Mark Zuckerberg apologized, and engineers actually had to go on site to the servers to reset them in order to fix the problem. And this led to millions of downloads on Signal, which is an alternative messaging app. One key proponent there is Jack Dorsey.
How did it affect Facebook stock then, Laura?
Well, Facebook was already under pressure yesterday, and that's because a former employee turned whistleblower gave an interview on CBS 60 Minutes. So at that point, the stock was trading down on Monday around 4.2%. When news of the global outages hit headlines, the stock closed down 4.8% and led to a broader tech sell-off. For instance, the Nasdaq closed down over 2% yesterday.
Okay, Laura Wright, looking at the Facebook story, that outage yesterday, the impact on the stock. Thank you very much indeed. Let's dig deeper into this story with Bloomberg's Roslyn and Matteson. Ros, do these big outages feed into, then, the broader debate about regulation, the need for regulation of big tech, particularly on Capitol Hill?
Well, it certainly raises fresh questions about how all-encompassing these companies are, how an outage can affect millions or even billions of people and businesses around the world on multiple platforms, all owned by one company. And you saw the U.S. Representative Alexandria Ocasio-Cortez coming out already and saying Facebook is a monopoly whose reach needs to be broken up. And as Laura was just saying, we have the Senate hearing, of course, in the U.S. today with the Facebook whistleblower, so the timing for the company is not great. It shows several things. Really, one is the vulnerability of the system to one company's outage for businesses as well as individuals and political groups, and the reliance of these individuals and political groups on WhatsApp for communications and their organization. So you can really see it opening a fresh front in that discussion.
So, Roz, less than a minute here, but I'm wondering, this isn't just a U.S. problem. How are governments around the world changing their stance when it comes to regulation on big tech?
Well, that's right. You see countries really rallying behind their criticisms of big tech, be it Facebook or ride-hailing companies or e-commerce giants questioning the power they have. You see probes of these companies not just in China, but in South Korea and Europe and elsewhere. And that's about a bunch of different things, that kind of monopolistic behavior in delivery of services like ride-hailing and e-commerce, or it's about the information that some companies facilitate and whether that's enabling fake news, hate speech, and so on. But equally, it does risk becoming a bit of a
we're going to have to leave it there because we're running short
government.
of time. But thank you, Bloomberg's Ros Matteson. Plenty more coming up. This is Bloomberg.
fearful. They don't know what to say. Again, they can't even fathom that they're out of Afghanistan. They're still in a state of shock and can't believe it.
What we have built through this process is essentially a mechanism for getting oppressed women and girls out of Afghanistan. So we're actually going to circle up and see what resources we have left, to see what options we have left, what mechanisms we have left, and actually look at potentially trying to get more women and girls out of the country as well.
We've been through a lot, us as a team. I know sleepless nights, but you know what? There's nothing more satisfying than knowing that you've saved many lives, and will continue to support these girls on their mission.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Welcome back to The Open. We're 30 minutes into your European trading day. Here are your top stories. The global sell-off deepens. The S&P closes at its lowest since July amid concerns about surging prices. Asian stocks fall as another Chinese property developer misses a bond repayment. Facebook suffers a devastating outage across its most popular platforms. Millions flock to competitors, and Mark Zuckerberg's personal fortune plunges by $6 billion. And oil rallies to its highest since 2014 after OPEC Plus maintains gradual supply increases despite the energy crunch. Tom, I really feel like the story capturing markets yesterday, not least of which because people couldn't check their Instagrams, was this more than 2% sell-off in tech. Has so many things to be concerned about, of course, higher rates being one of them, that discount that you're going to get on the future cash flow.
Yeah, and there's a bit of dip buying, it seems, in Europe on the moment in technology, but how long that's going to be sustained? Our previous guest that we spoke to from Hermes and Newton in the last couple of hours saying that, look, short-term value, cyclical, that still works. Longer term, there's an opportunity to pick up some of these growth names, but certainly the concerns about the yield story, that is front and center, slowing growth, the premiums that you're paying for some of these growth stocks. But right now, with the US 10-year relatively stable, at least in today's session, it seems like investors are getting back into technology, at least for now. The sustainability of that, of course, is in question. You have the likes of Deutsche Bank saying that the talk from their clients is very much about the concerns around stagflation. That wall of worry remains very much in place. But still, the Stoxx Europe 600 currently gaining just 1.5 in terms of points, up 0.3%. The DAX is gaining a little bit less than that, up 0.1%. The CAC 40 up 0.3%. And here in the UK, gaining and outpacing some of the other indexes, gaining 34 points. The politics still in focus here in the UK amid the Conservative Party conference that's taking place in Manchester. Prime Minister Boris Johnson to speak tomorrow, as of course this country wrestles with problems around fuel shortages at the supermarket, and energy prices as well, not just afflicting the UK but across Europe and the rest of the world. The banks are gaining 0.8%. Travel and leisure also in solid territory and on strong footing this morning, gaining 0.8%. At the bottom of the list, you've got auto parts, telecoms and construction and materials. That is how things stand 30 minutes into the trading session across Europe. Danny.
Of course, WTI crude factoring into this global equity picture as well. The commodity itself moving to the highest in almost 7 years after an OPEC Plus meeting, which stuck with its slow and steady plan of production increases. The cartel and its allies have agreed to add 400,000 barrels a day in supply. Many were expecting tightness in the market to prompt a boost by as much as twice that amount. For more, we're joined by our energy reporter, Stephen Stupczynski in Singapore. Stephen, we had oil prices jump. However, how do we square that with an OPEC Plus announcement, which many had seen coming?
You know, I think the big thing to focus on is the deficit in the market. You know, there is more demand than there is supply going into the market. OPEC Plus already did the calculations. They expect 900,000 barrel deficit for November. They're only adding 400,000 barrels a day for that month. So that shows that they weren't really willing to meet that deficit, and that still shows that there is going to be this tightness in the market. At the same time, you're hearing folks like Saudi Aramco saying they're already seeing these surging natural gas prices. Utilities are switching from natural gas firing their power plants to oil products. So that's boosting demand from oil as well. So not only do you not have enough supply, but the natural gas and coal rally that's ravaging the world is starting to leak into oil. This is a global energy crunch that's materializing right here.
Yeah, and so far, OPEC Plus not budging. We'll have to see whether that continues to be the case or they feel compelled to move. And talking of moving, we're going to move on to the big take today, which I know, Stephen, you've been involved with as well, looking at the clean energy transition and the current crisis, how the two overlap. Why are we facing this crunch right now, Stephen?
Well, it's a bit of a perfect storm of a lot of different things. You know, first I'll look at natural gas. You know, demand for natural gas, which is used for power plants and heating and chemicals as a feed gas, boomed this year because after COVID crashed demand for the fuel, economies came roaring back, specifically China, and that demand really exploded. Unfortunately, there wasn't enough supply to meet that demand, and on top of that, last winter was cold. And so there was a lot of inventories getting drained last winter. There's not enough supply. Plus, on top of that, you've got this post-COVID economic recovery. All those things combined make for a really tight situation in the market. But to make it all worse, countries like the UK, even to the United States, they're depending more and more on intermittent renewables. You see, you know, solar and wind make up so much more of their grid. So when the wind isn't blowing and natural gas prices are high, that creates a very difficult situation for everyone. Power prices will hit records, and that's what happened.
And there certainly has been some criticism of reliance or more reliance on wind. Given all those dynamics, Stephen, what does this mean over the long run for energy prices?
You know, I think volatility is just the name of the game, really. I mean, it's not the fault of the renewables that this is happening, but what's going to happen is they're going to exacerbate these shortages and potentially cause more volatility in the market going forward as there are slight crunches, or if an LNG facility comes offline, or if there are problems with coal mines in China. It will just make everything a bit more worse. But going into the future, you know, in 2030 and 2035, 2040, when there are more renewables, everything is expected to become much more stable as we kind of shift into that new green economy. But the in-between is where the volatility lies.
Okay, volatility, the name of the game, Stephen. Let's bring in Rachel at this point. Rachel Morrison, our energy reporter, who's also been involved in today's Big Take. Rachel, what are the idiosyncrasies within the UK's energy challenges? Stephen touched on them there.
Yes, the UK has been a really unfortunate example of the sky-high prices that have affected global markets, but also having a very low period of wind. And although the weather hasn't yet got cold, that has really accentuated all of these factors. So the UK has reduced emissions, got off coal, built up offshore wind capacity, and then the backup to that at the moment is gas. So the UK has been particularly affected by this crunch, and gas prices are at a record again today. We had the government yesterday coming up with an interesting proposal to make the electricity on the grid totally green by 2035, and this will involve nuclear. So we heard a lot of talk about energy independence. We're hearing the same from Brussels, with countries taking away from this crisis the need to get off volatile gas. Stephen mentioned volatility, and that's what's really worrying the politicians.
All right, a very complicated story with a lot to dig through. Thank you both for joining us. That's Rachel Morrison and Stephen Stubchinsky, both are Bloomberg News reporters. Now, coming up, the UK's Rishi Sunak calls excessive borrowing immoral and hints at future tax cuts at the Conservative Party conference. We'll have a look at that next. This is Bloomberg.
dealing with that blackout risk, those energy prices spiking?
Well, in the first instance, we will manage it over the next while. I think the key agenda item for Ireland on the energy front is wind, and we've been great developers of onshore wind. The next decade in Ireland will be offshore wind, and we have streamlined our planning application framework for investors so they have certainty in terms of applying to invest in terms of offshore wind infrastructure in Ireland. So that will be a key agenda item of ours, and renewables. We have a very strong climate component in our government and in our government programme, and that, of course, is not disconnected from the energy agenda. And there will be challenges of that, there is no doubt, but we are making considerable progress.
Are you worried about the here and now? Are you worried about blackout risks? Are you worried about the amount of consumption data?
Data is taking up considerable demand in energy terms, but we have been robust in terms of meeting that to date.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Welcome back to the Open. 40 minutes into the European trading day. Some of the early optimism we got in session starting to fade somewhat. The Stoxx Europe 600 gaining 0.2%. So pairing some of the stronger gains that we saw in the first few minutes of the Open. The FTSE 100 still gaining and up by 0.5%. In terms of the sector breakdown, top of the list, you're looking at banks. Bottom of the list, you're looking at construction. Okay, let's get the first word news now with Laura Wright. Laura.
Thanks, Tom. Facebook suffered a major outage for around 6 hours yesterday, shutting many of its 2.7 billion users out of its services. It blamed the technical issues on technical problems, adding there's no evidence user data was compromised. Facebook's stock took a hit, with CEO Mark Zuckerberg losing about $6 billion and dropping to number 5 on the rich list. President Biden is warning that the US is at risk of breaching its debt limit in 2 weeks. He's describing it as a meteor headed for the economy and blames the Senate's Republican leader, Mitch McConnell. The president is calling on the Senate to suspend the debt limit by a simple majority, which would stave off the risk of default. There's an update in the scandal currently plaguing the International Monetary Fund's chief. The group's executive board met with the law firm that accused Kristalina Georgieva of improperly pressuring subordinates while at the World Bank. She's accused of getting them to adjust a global ranking in China's favor. The IMF says it remains committed to an objective and timely review. The Federal Reserve's internal watchdog plans to probe trading activity by senior U.S. central bank officials. It follows revelations about transactions last year that forced regional chiefs Kaplan and Rosengren to resign. Last month, Chair Jay Powell opened an internal investigation into the central bank's ethics rules. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Tom, Danny.
Laura, thank you very much indeed. OK, let's switch to UK politics now. And the UK's Chancellor of the Exchequer has said it would be, quote, immoral to accumulate bills and borrow excessively to pay them. Speaking at the annual Conservative Party conference, Rishi Sunak said he would not make decisions based on, quote, fear, but would do whatever it takes to improve the UK economy.
Our recovery comes with a cost. Whilst I know tax rises are unpopular, I want tax cuts, but in order to do that, our public finances must be put back on a sustainable footing. The worst parts of politics are driven by fear. We will do whatever it takes. I remember over 5 years ago being told that if I backed Brexit, my political career would be over before it had even begun. Well, I put my principles first and I always will. I believe in fiscal responsibility. Just borrowing more money is not just economically irresponsible, it is immoral.
And joining us now is Alan Wager, Research Associate at UK in a Changing Europe. Alan, we heard there, of course, from the Chancellor of the Exchequer, Rishi Sunak. It seems that there is something of a division within the Conservative Party. Those in the north who want to see this levelling up and therefore more spending. Those in the south and southeast who would like to see tax cuts and a return to what many would argue would be traditional Conservative ideology. What were the key takeaways, or what have been the key takeaways from the party conference for you? Where is the focus?
Well, there's a sense in which the Conservative Party continues to defy political gravity. You know, Boris Johnson continues to be popular despite the level of disruption we're seeing in the UK economy at the moment. And therefore, you know, not only internally is he still quite a strong prime minister, but there's a sense in which the Labour Party isn't, currently able to profit from the problems that the Conservative Party faces. I think that's to disguise some of the sort of structural issues that do face Boris Johnson. As you say, potential internal division about an economic focus, which is sort of in a way the core basis of Conservative support, and Conservative fundraising and things like that. And also the fact that we've got, COVID, the sort of insulation from COVID's out, and Brexit is becoming more unpopular. So actually, I think we're starting to potentially see a more difficult sort of autumn and going into winter for the Conservatives and for the Prime Minister.
Do you foresee that difficulty, though, translating into public opinion changing about Boris Johnson, which, as you point out, hasn't really, despite some of this disruption throughout the UK? I think one of the things is it never changes until it doesn't, until it reaches a sort of tipping point. The sort of level of disruption, there isn't any sense in which the Boris Johnson is in any danger, and he has a sort of solid base among the sort of right bloc of voters in the UK, with no sort of challenger to his right, which makes his basis of support a lot sort of stronger than it maybe would have been in the past, when you had the likes of sort of Nigel Farage or the Brexit Party sort of challenging him. And the only time you saw the Conservative Party go behind Labour in the polls was when you saw a significant upsurge in people saying they'd vote for parties to the right that was very, very short-lived in the wake of the national insurance rise. So at the moment, the lack of any challenger to Boris Johnson's right means he can sort of make these sort of more populist appeals, if you like, on the economy without risking his base. That's the calculation. I mean, the reality is potentially that that threats from internally from his party will make that difficult to sustain in the long term.
Do you think that's a message he's going to re-emphasise in his speech on Wednesday? How do you think he's going to craft that messaging?
I think one of the key things we're seeing that's rising up the agenda again is immigration, and the idea that some of the disruption we've seen in the UK economy can be seen as a necessary price to lower immigration. And for the last 5 years, we've seen concern about immigration drop substantially in the UK, not just in the UK, but also in places like the US. And the calculation from the Conservative Party is that there is a residual dislike for uncontrolled immigration, and they can say all this disruption is a consequence of moving to a high-wage, low immigration economy. And that's the key message that he was bringing home this morning in broadcast interviews. And that's a big potential gamble. What's the cause of the fact that we've seen much lower salience on immigration and much lower concern about it? Is it people have stopped talking about it? And if he starts talking about it again, then that can be something that rallies Conservative support. That's going to be a key thing to watch in the speech tomorrow. Mm-hmm.
That's definitely an interesting contrast with this idea that they're able to move a little bit more to the left because the vacuum that's there at the moment. How do you square those two things? Could there be an ideological shift, is perhaps too strong of a word, but a nudge in that direction for the entirety of the Tory party given that vacuum left?
Yeah, I think the basis of Conservative support is a lot more to do with social conservatism than sort of right-wing economics now. I think that's the calculation, and they do look at the median voter. The average voter in the UK is someone that is, socially conservative, but also probably quite left-wing, sort of populist on the economy. And what we've seen is sort of populist turn, if you like, in the Conservative Party towards trying to maintain power by holding on to as many of those voters as possible. And there are some sort of small state ideological Conservative MPs particularly, but they're currently Boris Johnson's currently protected by his very large polling lead and by the fact that people still think that he's a political winner. So the ideological bent of sort of Thatcherite wing of the party remains sort of pretty sanguine at the moment during this conference.
Alan, some of the guests that we've been speaking to, some investors have flagged the risks around Brexit again and these negotiations around Article 16 in the Northern Ireland Protocol. How pertinent is that concern? How do you expect that to unfold? We know the Europeans are going to put forward their proposals later this week or next week.
I mean, it's increasingly likely that the UK government will sort of make a song and dance of triggering Article 16, but I mean, that'll be such a long, drawn-out process that's unlikely to sort of come to a head for sort of a couple of years. And I mean, the probably outcome is, it's probably pretty foregone that the EU hasn't sort of breached any article of faith within the protocol. So I don't. But I think maybe that's something that we're seeing in this conference. There was a meeting of think tank of Policy Exchange yesterday where the discussion centred on the fact that basically, trade between Northern Ireland and Ireland is working too well for the UK government. So I think there is a very, very real sense that the UK government wants to show a political challenge to the protocol and signal its intent on Brexit.
Alan, just quickly here, but I need to ask before I let you go, considering the energy crisis, the line at the pumps that we're seeing in the UK, do policymakers need to be doing more at this moment to address those?
Absolutely. And I think the problem for the Conservatives at the moment, and we saw this in interviews that Boris Johnson has done this morning, is that he's gone into this conference with the slogan, get on with the job, but there isn't any clear sign for UK businesses that there is any sort of plan to deal with the current problems to do with supply chain and shortages and so on. So this will drag on and on, likely for the next few weeks and few months. And that's a pretty serious problem and a pretty serious indictment for what is, or has long been thought of to be the party of business.
Yeah, and it's a challenge for them politically as well when the editor of the Sunday Telegraph comes out and calls desperately for a plan, for a strategy. Alan Wager, Research Associate at UK in a Changing Europe. Thank you very much for those insights. Coming up, OPEC Plus, sticking to planned gradual output hikes. We'll dig deeper into how the markets are reacting with our MLive team. That is next. This is Bloomberg.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Welcome back to The Open. We're just under an hour into your European cash equity trading. We're looking at gains across the board. The weakest of the sectors being the DAX, basically flat on the day. We're seeing some of the other sectors that have energy companies, for example, like France over there, up 0.3%. But the broader equity benchmark just up 0.3%. Let's dig into some of this market action with Bloomberg MLive's Noor Al-Ali. She joins us now. So, Noor, part of what's driving the markets today, and indeed the past few days, has been higher energy prices. Given those dynamics, is it fair to start having that stagflation discussion?
I'm going to say let's wait off a little bit on stagflation. I'm a little bit more concerned about the inflationary environment that we've got currently, and you need to have persistently high prices and price pressures for stagflation to come in afterwards. So I think that for me is a little bit more of something that I would pay more attention to at the moment, but that doesn't mean that stagflation isn't of interest. I mean, stories on the Bloomberg terminal have really topped when it comes to mentions of the word stagflation, but realistically, inflation is still something that I'm a little bit more worried about for now.
Yeah, and of course, you can't talk about inflation without talking about oil. You can't talk about oil without talking about OPEC+, their decision to keep output as they had planned. How is that factoring into market sentiment, Noor?
Well, absolutely. I mean, this is the time to ride that bullish wave for crude. I did a little post yesterday that looked at some oil indicators that just saw how bullish the market is at the moment. And if you look at time spreads, if you look at an oil skew that determines that determines the volume trading based on puts and calls, and also even the commitments of traders, you will see that the market is actually quite bullish when it comes to crude. So now is the time for Brent to shine into the year, especially with the energy crisis on the back foot.
Okay, so that's the energy crisis. What about the crisis in China and the property sector?
Well, Tom, you know it better than I do, probably. It's not looking very good, especially with another country also not defaulting, but missing a payment on one of its bonds as well. I mean, junk bonds out of China have hit or are set for their worst performance since 2013. That should just give you an indication of how badly that sector is performing. But realistically, any move or signal from the PBOC to cut rates, that's a good thing overall for equities there.
MLive's Noor Al-Ali breaking down the market moves and what to look for. Thank you very much indeed. Across Europe, you're seeing gains of 0.3% this morning. Stay with us. Surveillance Early Edition is up next. This is Bloomberg.
China's growth because it is already slowing. Chinese manufacturers are curbing production. This is the latest shock to global supply chains, already delayed by, part delays, chip shortages, saddled with soaring commodity prices as well.
Well, Haslinda, when we've seen a lot of supply chain disruptions at the beginning of this COVID pandemic, and then, supply chains became resilient and it really moved goods around, especially medical goods and supplies. But now at this part of the pandemic, we are seeing disruptions again, and discontinuities. And that is because of what we spoke about, the demand that is pent up. And of course, if you have factories slowing down and, not being able to produce as much, that is going to impact growth and the recovery.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
That is the only mandate of the Fed, price stability and full employment. And let's be clear, right now we don't have price stability.
But above all else, we must defend to the hilt our economic interests.
We don't want to be dependent on the supplies coming from foreign countries. That's the key point.
This is Bloomberg Surveillance, early edition with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in Paris for the OECD conference where the Secretary of State, Anthony Blinken, is also here. Now, here's what's coming up on today's program. Facebook suffers a devastating outage across its most popular platforms. Mark Zuckerberg's personal fortune plunges by $6 billion. Ken Griffin has a message to the young. You are making a grave mistake by working from home. The Citadel chief executive spoke to Bloomberg. And an exclusive interview as the energy crisis worsens. We speak to the former BP chief executive, John Brown. If you have any questions, just IB plus TV Go. Now let's get straight to our top story. It's definitely the markets after the rout we saw yesterday, not only some of the tech stocks, but overall a worry about inflation, of course, overall worry about what kind of growth we'll be left with. So let's get straight to Danny Berger in London. Hi, Danny.
Hi, Francine. Look, we did open up on these European equity markets higher. Futures were higher, but we're having a difficult time really sustaining any significant gains. You're looking at an S&P 500 future session, which is flat. It's unched, no change. And then you have some dip buying when it comes to NASDAQ futures. But Francine, really the pain has been in longer duration. So in these big tech type things. So we're not getting dip buying. It's not enough to really get people in, be it higher rates. That's the concern, regulation, so on. But you are seeing some dollar bid buying there. And Brent also moving higher beyond $81 a barrel. Now, this all comes to this concern about prices. How acute is this price rise going to be? If it is a lot, if we are seeing rates moving higher, it stands to reason you don't want that big tech. And this regime change idea really is captured very well by James Bullard, who yesterday, the St. Louis Fed president, talked about a changing mentality from corporations, saying he's concerned about it and the relative freedom that businesses feel they can just pass on in terms of increased costs easily to their customers willing to pay it as well. So if that is the environment we're in, if Bullard is happy to raise rates soon, what happens in this market? You sell tech. Of course, the FANGs, about 20% of the S&P 500 index, taking a bath yesterday. So that really affecting the entirety of the market. And Francine, we're really struggling to make up for those losses this morning.
Yeah, so we look at high valuations. We also look at high yield in China. Danny, another Chinese developer, of course, falling into crisis on Monday after failing to repay a nearly $206 million bond. Now, Fantasia is adding to the strains of the nation's heavily leveraged property firms following industry giants Evergrande's debt troubles. So let's get the latest on Fantasia with Bloomberg's Rebecca Chung-Wilkins, who joins us. Rebecca, thank you for being with us this morning. Quite a lot going on, of course, in China. What are we seeing, or how are we seeing stress manifest across China's credit market today?
Well, we're seeing a pretty savage sell-off in China high-yield debt this morning and later coming into the afternoon session. Bonds on average down about 5 cents on the dollar. Those single B weaker rated names down as much as 10 cents. And I think, you know, the real concern here is after sort of Fantasia took the markets by surprise with this default, although it was known that it was sort of having some issues with its financial health, the real worry is that the kind of refinancing risks for property firms become unmanageable and it becomes a self-fulfilling prophecy where borrowing costs soar and kind of weaker firms are unable to tap the offshore bond markets to kind of roll over all of this masses of offshore and dollar debt that they need to repay this year and through the next 6 months. And that, of course, the worry is that will lead to more defaults. And defaults we've already seen leading the kind of record wave of corporate bond defaults in China's corporate bond market so far this year.
Rebecca, thank you so much. Rebecca Chung-Wilkins there for us on some of the high-yield credit that we're seeing in China under pressure. Now, Facebook's Mark Zuckerberg has apologized for a global services outage that kept its social media apps offline for much of Monday. Now, for more on the story, Bloomberg's Laura Wright joins us. So I think we'll get to Laura actually in a second. A couple of connection problems between Paris and London. I don't know whether it bodes well or not for foreign relations, but we'll get plenty more, of course, on Facebook shortly. Yesterday, the outage lasted about 7-8 hours. I know we'll break it down. Of course, we'll also see what Facebook is doing to stop avoiding that. It's 24 hours after we heard from the whistleblower. Now, Smart Conversations continue on Bloomberg Surveillance Early Edition. So coming up, we'll look at the markets, we'll look at the energy crisis deepening. A little bit later on, we speak exclusively to the former BP chief executive, John Brown. You can send any questions you want to IB plus TV Go, or you can also tweet me directly at Flacqua. This is Bloomberg.
What have we learned from this evergreen crisis so far?
From my investment perspective, I think diversification is very important. So far this year, we've seen many events, right? Maybe in the fintech sector and education, casino, and property. So I think diversification help you lower your risk on your overall portfolio.
Medium term, though, are you seeing more risk and reward in the high yield space in Asia? I mean, how are you viewing this right now? Are there actually buying opportunities given just the selling we've seen?
This time is a bit different in the property cycle because in the last, when you see there's a tightening measure, there's always demand there, right? Just the government trying to suppress the demand. But this time we're seeing a confidence issue, is like a buyer strike because of the sentiment. The evergreen is hurting the sentiment and people don't want to buy. And other developer because they want to get cash.
The August jobs report packed a big downside punch.
That is a really, really dismal number.
Will September bring enough good news for the Fed to start a taper?
If progress continues broadly as expected, a moderation in the pace of asset purchases may soon be warranted.
Will unemployment keep going down? And what's happening with wage inflation?
It might be a little bit more sticky than maybe Jerome Powell and some of the Fed members think.
Tune in for the September jobs report, Friday on Bloomberg Television and Radio.
We don't trade crypto because of the regulatory uncertainty. We often make markets in companies whose business models I don't really have fondness for, because one of our jobs as a market maker is to meet the liquidity demands of American families that want to invest in X, Y, or Z. And frankly, it's not my job to tell them if they're right or wrong. It's my job to provide them with the best possible price. Because of the lack of regulatory certainty around cryptocurrency, we just aren't involved today. And I really believe that Chairperson Gensler is spot on the need to have thoughtful regulation around cryptocurrency. I actually think that doing so will make it a smaller market because it'll become a far more competitive market when there's regulatory clarity. And that will be good. A smaller market, less people involved who are frankly just trying to make a quick buck. And whatever the virtues are of that product, and I think those are pretty nebulous, will become very different in a world of competitive exchanges and competitive pricing by tier one market makers willing to put their best foot forward. So I really believe that Chairperson Gensler is spot on the need for regulation. And the SEC has got a solid history of writing good regulatory policy.
To be clear, though, if it were regulated, you would trade it?
I would trade it because it would meet the needs of our online brokerage partners who want to have a tier one firm making prices. I mean, part of the reason that we are so significant in retail market making is our incredibly high reliability. We're there every day and every minute of every day. And we provide a great service every day and every minute of every day. And they want us to provide pricing in crypto. I just don't want to take on the regulatory risk in this regulatory void that some of my contemporaries are willing to take on. If you are early in your career, you are making a grave mistake not being back at work. It's incredibly difficult to have the managerial experiences and the interpersonal experiences that you need to have to take your career forward in a work remotely environment. Work remotely is very good at maintaining the status quo, but the world's not static. Competitive pressures from around the world will put American businesses continually under pressure. The Chinese have been back at work literally from almost the start. They're continuing to evolve at a very rapid rate of innovation, and we are in many ways stuck in patterns from 18 months ago because it is so much harder to create and to innovate in a remote working environment. So for our youngest members of our workforce, I'm gravely concerned that the loss of early career development opportunities is going to cost us dearly over the decades to come.
The founder there and chief executive of Citadel, Ken Griffin, giving his thoughts on crypto and working from home. I have to say it was a 1-hour conversation with our Eric Schatzker. It was a good conversation, and Mr. Griffin had opinions on everything. Now we're joined by Edmund Ching, Chief Investment Officer of BNP Paribas Wealth Management. Ed, great to speak to you as always. I have a million questions on tech valuations. I have a million questions on crypto and actually what happens to the markets. Are we heading towards a pretty severe correction, especially in tech stocks?
Well, hello, Francine, first of all, of course, and welcome to Paris. What I would say is that this has been somewhat overdue, in my view. We also have to bear in mind that September and often October, September is certainly the weakest seasonal month of the year for equities historically, and October is somewhat volatile as well. So a correction is unsurprising. What is perhaps more surprising is we haven't had a correction so far this year. It's been almost if you draw any chart on your Bloomberg terminal of equity indices, it's pretty much bottom left, top right in a straight line. That's very unusual. We haven't had any corrections of 4% until now. Now maybe you've got a correction of 5, 6%. Okay, a little bit more in the tech heavyweights, but let's not forget that comes against the backdrop of fantastic gains in those tech mega caps over the last couple of years. It's really been quite an extraordinary ride. And really, to see a small drop now, I think we should not exaggerate and say, is this going to turn into a bigger correction? Of course, it's always possible. But for me, when I look at the underpinnings of equities, you say earnings are going the right way. Earnings forecasts are still going up and quite sharply. And secondly, long-term real yields in the bond market remain very solidly negative. And there's no sign that central banks are going to change that anytime soon.
So what are we worried about? There's quite a lot of high-yield credit things in China that we could worry about. A spillover effect. It's very clear that developers are under pressure. Could it actually infect the rest of the market in the West and elsewhere?
Of course, because Chinese economic growth, were it to collapse, would clearly have a huge impact on global economic growth, and therefore we all, it's in the old days we used to say if the US sneezed, Europe caught a cold. Well, I think that's probably more true of China these days. That if China has a hiccup, we all suffer to some extent. Now, is that going to happen? Are the Chinese Communist Party and the Chinese administration going to allow contagion in financial markets to spread from Evergrande into, for instance, the residential property market? I think they're going to do everything they can to prevent that. They will, I also believe, attempt to force an orderly restructuring of Evergrande so that we don't have this spillover effect into Chinese residential property markets, because that is hugely important to the Chinese economy. So they can't afford it, basically. And we live with uncertainty, but the equity markets and financial markets always live with uncertainty. That's why we call it climbing the wall of worry more often than not. And I think that's where we are today.
And when you look at some of the biggest valuations out there, what do you buy at the moment? So there's still the energy crisis that's looming. We could see, of course, a lot more pressure on some of the margins, which is why we're seeing quite a lot of analysts actually also repricing some of their earnings expectations. What do you buy right now?
Well, I think the biggest story out there is the commodity story, because let's not forget that if you were to look at the Bloomberg Commodity Index, until relatively recently, it was a pretty sorry state of affairs. It was a pretty ugly chart. I mean, you've put the one-year chart up there, which looks fantastic. If you were to put the 10-year chart in there from 2011, it would look almost the mirror opposite of what you see there. It would be top left, bottom right. It would be a tale of woe. Now, we're just recovering from that. So we've had one good year after 9 or 10 pretty poor years for commodities. And I think there is more ahead. I think inflation will be more persistent for longer. Commodity prices, risks staying high for longer. Now, OPEC Plus, with their announcement yesterday, were very clever in that they clearly boosted oil prices. But the question is, Francine, when we talk about stagflation, remember, what is stagflation? It is the point at which these persistently high prices cause demand destruction. Now, is Brent at $81 a barrel going to do that? The answer probably at the moment is no, but they can't go that much higher, because when we get into the hundreds, then you really do risk demand destruction, and that's something that the OPEC Plus nations do not want at all.
Ed, thanks so much. Edmund Shing, their Chief Investment Officer of BNP Paribas Wealth Management, stays with us. Now, let's get straight to Facebook with the very latest of what happened yesterday. Here's Laura Wright. Hi, Laura.
Well, perhaps you felt some panic yesterday, Francine. Roger Hearing on radio compared it to living in the 70s. A network configuration at Facebook led to a global outage, impacting 2.7 billion users of Facebook, Messenger, Instagram, WhatsApp. It was down for around 6 hours. Even Facebook's internal systems were affected. Engineers had to be on site to physically reset those servers to get things going again. Many users flocked to alternative messaging platforms such as Signal, which is non-profit. That saw millions of new downloads yesterday. So what did this mean for Facebook's stock price? Well, it was under pressure even before news of the outages became apparent. That's because a former employee turned whistleblower gave an interview on Sunday evening pertaining to Facebook's privacy policy. But once the outages made the headlines, Facebook closed down 4.8%, and that led to a broader tech sell-off, with the Nasdaq closing down over 2%, Francine.
Laura, thanks so much. Laura Wright there with the very latest on Facebook. So let's get back to Edmund Shin. Ed, are you buying any Facebook at the moment after the huge sell-off yesterday, or does it just look too risky? I don't know whether regulation and breakup is back on the cards.
Well, yeah, I have a moral objection to Facebook. I really don't like the company. I don't like its products. I mean, WhatsApp is an incredible product, as is Instagram, but I really don't like them, because I do think there is a huge moral issue about young people and about our children, and about the fact that they become addicted to these apps. And that really worries me, particularly with Instagram. And what I think the Facebook outage has shown us is just how much we do rely on things like WhatsApp. I mean, my wife was pulling her hair out yesterday because, I have kids in London, I'm sitting in Paris, we were trying to contact our kids. We always use WhatsApp to do that because it's so convenient. And yet, guess what? Yesterday, my wife couldn't figure out why it suddenly wasn't working.
I know.
Right? But you're right, it's interesting. So we did use Signal. So, but I think it will give people a wake-up call as to how much we rely on this necessary infrastructure and how much Facebook sits behind all of this. And maybe people will continue to look for alternatives to try to diversify.
On morality, is there any
Yes.
other industry group that you're shunning?
There are always plenty. But I have to say, technology is the one, internet stocks is the one that worries me the most. But what I would say is that while we as a bank, the Green Bank, push very much an ESG and a sustainability agenda, we are going through a very rapid energy transformation. And I would say that you cannot ignore energy stocks. I would be a buyer of energy stocks because I think oil and gas is not going to disappear. We are not going to go to a zero reliance on fossil fuels in the next few years. You only have to look at the explosion in natural gas and coal prices to tell you that. And we have not developed enough infrastructure for storing electricity, battery storage, or other forms of storage to be able to store the wind and solar energy so that when the wind doesn't blow, the sun doesn't shine, we still have electricity because unfortunately, users still want electricity 24 hours a day. So we need to put that infrastructure in place. It's going to be a huge investment. I think that's a huge opportunity for us. And it's something I think in Europe, we're going to grab with both hands, hopefully with the EU Recovery Fund behind us.
Ed, do you buy into cryptos at all? Would
No.
your clients ask you about crypto?
All the time. I think.
And they don't ask?
For me, the issues are, I think I do have to agree with Ken Griffin. There are issues about some of the actors in the space as to their how much you can trust them, and I'm not sure you can. I think there's a lot of shady operators still in the space, and as for us as wealth managers, that is a clear concern. Regulation needs to be put in place, and I think central banks and governments have been very clear that they want to put that in place. And I think the longer-term question is going to be the race towards central bank digital currencies, those so-called stable coins. Are these going to really challenge Bitcoin, Ethereum, and the other cryptos? I think there's a really good chance that they will in many areas, that people will find those attractive alternatives. And then the question is, what is the raison d'etre of Ethereum and Bitcoin in a world where you have these digital currencies provided by central banks, giving you that flexibility and ease of use that you currently get from the cryptos?
Ed, thank you so much for all of your insight. Edmund Ching, their Chief Investment Officer of BNP Paribas Wealth Management. Now, coming up, we'll talk a lot more, of course, about energy. Smart Conversations continue on Bloomberg Surveillance Early Edition as the energy crisis deepens. Later this hour, we also speak exclusively to the former BP Chief Executive John Brown, Lord Brown. Send in your questions on IB Plus TV Go. This is Bloomberg.
So the 1972 Madison Square Garden eyelet jumpsuit, which is arguably, from what we're finding out, probably one of the most important jumpsuits of Elvis's entire career. So it marked so many milestones really for him. It was used for an album cover. It was used when he performed Madison Square Garden, and he was the first performer to ever sell out 4 nights straight in Madison Square Garden. So he really started that whole thing that we see now in pop culture, where when you make it big, you do Madison Square Garden. So we're super honored to have it. I can honestly say that COVID has been unbelievable for internet-based and e-commerce businesses because we have a captive audience. We have people home that really want something to do and need entertainment. So we do our best to try to give it to them.
did you make the decision to move to the Bahamas of all the options out there?
We've been looking at the Bahamas for a while. They're one of the first countries to roll out any comprehensive regulation for cryptocurrencies, which we think is extremely important for the space and a really positive sign.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in Paris. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. OPEC Plus is sticking with its plan for a slow and steady increase in oil production. Ministers from the group ratified a 400,000 a barrel day hike for November, but due to the global energy crunch, many market watchers were expecting a bigger boost in output. That's pushed crude to the highest since 2014. The Federal Reserve's internal watchdog plans to probe trading activity by senior U.S. central bank officials. It follows revelations about transactions last year that forced regional chiefs Kaplan and Rosengren to resign. Last month, Chair Jay Powell opened an internal investigation into the central bank's ethics rules. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thank you so much. Now, coming up, we'll discuss green investments with John Brown, the chairman of Beyond Net Zero. There's a new $4 billion climate fund by General Atlantic. This is Bloomberg.
OECD nations need to end coal use by 2030, developing nations need to follow suit by 2040, and we need coalitions of solidarity between countries that still depend heavily on coal and countries that have the financial and technical resources to support transitions, because it is essential that no more coal power plants are built.
Watch Bloomberg Surveillance to learn how to look at markets, how to look at trends, and how to look younger.
What do you think, John? Botox, or do I really need to get something done?
I think, Tom, if we just change the style up a little bit.
You think so?
Yeah, drop the bow tie. Drop the bow tie.
What, skinny tie?
Yeah. I always say, this is my line, whenever anyone in America has to go at me about a skinny tie. The older you get, the wider it gets.
Oh, really?
Until it becomes a bow tie.
This is a bow tie.
Until it becomes so fat, you just sort of...
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Facebook suffers a devastating outage across its most popular platforms. Mark Zuckerberg's personal fortune plunges by $6 billion. Oil rallies to its highest since 2014. OPEC Plus maintains gradual supply increases despite the energy crunch. And an exclusive conversation as the energy crisis worsens. We speak to the former BP Chief Executive John Brown. If you have any questions for him or the team, IB Plus TV Go. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in Paris for the OECD conference. Well, we'll also be speaking to the Secretary of State, Anthony Blinken. Now, let's talk about energy, the crisis, and, of course, renewables. We're joined by John Brown, Lord Brown. Between 1995 and 2007, he was the chief executive of BP. Currently, he's the chair of Beyond Net Zero, a $4 billion new climate fund from General Atlantic, where he also serves as senior advisor. Lord Brown, thank you so much for joining us on Bloomberg Surveillance Early Edition, where we spend quite a lot of time trying to figure out the energy transition, what it means for energy crises going forward. What do you see, Lord Brown, as this prescription today for governments to make sure that we don't end up with more energy crises and energy concerns like we've had in the last couple of weeks?
So I think the rules really haven't changed, that you need diversity of supply and you always need a little bit of a cushion, because one thing about energy is you just can't turn it off and not suffer enormous consequences both to human beings and to industry and to markets. So it's more diversity, and I think we need to remember that while we're in an energy transition, it is a transition. And so we will still need hydrocarbons for quite a long time, as well as other sources of energy. And what we've got to do is we've got to figure out how to decarbonize some of the hydrocarbons in order to meet the net zero targets that are so important to meet by 2050.
But Lord Brown, if you look at the IEA and that important report, it basically says that we need to stop using any kind of fossil fuel if we're going to meet those targets that we set out in Paris. So how does it work? We have energy prices at the moment at a record high. We have oil prices also quite high, hurting growth, but it's very difficult to use some of these fossil fuels. What's the right balance?
So we still need to use fossil fuels. We haven't finished the transition. And it's important, therefore, that we maintain supplies that we need at the appropriate level. So you can see natural gas is really tight, both in the United States as a result of a lack of drilling in the shale basins and the lack of associated gas. So Henry Hub is up there. Gas prices in the United Kingdom here are enormously high as a result of demand around the world and a lack of supply. Many people diagnose that as Russian supplies falling short. Actually, Russian supplies are higher than they were certainly a year ago, and that is not the only reason for this. So a lot of demand. We still need hydrocarbons. In order to satisfy the net zero targets. We have to do things like CCS, carbon capture and storage, decarbonizing hydrocarbons, as well as dramatically increasing other sources of energy, such as renewables, which clearly are very competitive with fossil fuel prices, as well as nuclear, which is something which I think the debate is around now, a positive debate, that we need to get some more nuclear into our system.
But so, Lord Brown, first of all, if you continue using fossil fuel as you transition, how long does it delay the transition by?
So I think it depends on how you use the fossil fuels. We have to decarbonize them. So you take natural gas and you use it to make electricity, but in so doing, you capture the carbon dioxide and either bury it or use it for something else. That is what you need to do. And so it is very important to decarbonize hydrocarbons while we're using them over, let's say, a 20-year period. There are plenty of other sources of energy. They need to be increased dramatically. After all, we need to invest enormously into infrastructure to do that. I think the latest estimates are $3.5 trillion a year. We're investing, let's say, about a third of that at the moment. So we need to increase our investment levels to a very high level here.
What's the right way of managing some of these emissions, and how do you avoid actually greenwashing or miscalculating, scope 1, 2, and 3? So what's the right way of doing it so that we make a real difference instead of just putting labels that don't mean anything?
So the most important thing is to make sure that we try to get the low-hanging fruit. First, we've got to make sure no methane escapes from human activity into the atmosphere. Methane, which is natural gas, is probably 100 times more damaging than carbon dioxide. And we need to lock that up. We can measure that from space. We can see what's happening. We need to make sure that nobody emits unnecessarily methane, point one. Point two, we need to make sure that we keep increasing investment. We keep thinking about different technologies to use hydrocarbons in a carbon-free way. We can't turn them off yet. It would be very nice if we could, but we can't. But we have to do that in a very sensible way. We've got to, in order to get to net zero by 2050 and 1.5 degree temperature rise, which is an ambition we should still hold, we have to get rid of half our carbon dioxide in the next 10 years. That means we need to move very quickly, decarbonize everything we do, keep efficiency rising, keep adding more and more non-fossil fuel to the electricity pool.
So, Lord Brown, how do you see the role of private capital in tackling climate change? And can you talk a little bit about Beyond Net Zero? Why now?
Well, Beyond Net Zero is part of General Atlantic. General Atlantic is a tremendously successful and experienced growth equity fund. And we've concluded that as part of General Atlantic, it's important to invest horizontally in the growth of activities in different sectors that reduce carbon dioxide, whether that is better control systems to distribute electricity in an effective way, to control industrial processes, to reduce the amount of energy they use, to change the way we think about farming, for example, to invest in things like vertical farms, and to decarbonize hydrocarbons with carbon capture and storage, or, for example, converting natural gas into hydrogen without emitting any carbon dioxide, and using that hydrogen as a clean fuel around the world. So there are plenty of things to do, and this is the right moment to do it.
Where do you see the most opportunities? There are some investors that say actually the right way is to invest in clean tech further down the line rather than buy a green ETF right now.
Well, I think I would always say invest in proper businesses and make sure they grow, and that's important, to grow them to the level that they begin to move the needle. And there are, right now, 80% of the technologies we need over the next decade to really make inroads into carbon dioxide are available to us now. So it's a matter of investing them, making great businesses, and investing them directly. I think the most important thing for everyone to do is to set proper targets here. We have these big macro targets set by governments, but every company needs to set targets probably in line, which I believe in, the science-based targets, which are independent targets set for each sector, and actually track year by year, not over 30 years, but year by year, first 5 years, 10 years, what you're actually doing. That stops people saying they're doing something and not doing it, so-called greenwashing. So investing in companies and not greenwashing.
And on the greenwashing, How should asset managers, what should asset managers do actually to avoid greenwashing, given we don't have the same labels for everything across the world?
Sure. But I think they should start by demanding targets for each company, targets which are set independently, and targets which the performance against which is verified independently. That, I think, stops people simply signaling virtue, but actually signaling real performance, a bit like financial performance. People expect targets to be set, to be met quarter by quarter, and that's the sign of a good company. I think the same is true with emissions of carbon dioxide equivalents. Set targets, measure them, probably not quarter by quarter, but year by year, against 5 and 10-year targets, and then explain what you're doing. And that, I think, is the hallmark of a great company. And indeed, in General Atlantic and Beyond Net Zero, that is what we want to do as we make investments with General Atlantic.
Lord Brown, how's fundraising going?
This is part of General Atlantic. So General Atlantic has a very large fund, and that's where we are at the moment.
Fabulous. Thank you so much for a very interesting conversation and your insights. Lord John Brown, the chairman of Beyond Net Zero, senior advisor to General Atlantic, and of course, former BP chief executive. Coming up, President Biden warns that the U.S. may breach its debt limit, blaming the Republicans for the meteor headed towards the economy. We'll get the latest next. This is Bloomberg.
Natanggap ko po ang inyong nominasyon sa akin bilang kandidato sa pagkapangulo ng Republika ng Pilipinas. I am a fighter, and I will always be a fighter inside and outside the ring.
Mistakes you've made or failures that you can talk about so that people could feel you're not just a superhuman?
People ask that question as if the only challenge is at work. Challenges come in a lot of different packages.
The growth story in cannabis remains very strong even after the sort of the loosening of the pandemic. There was a worry that there might be wallet spend competition, but so far the cannabis sector seems to be holding up very strong.
The Republicans in Congress, what they're doing today is so reckless and dangerous in my view. As soon as this week, your savings and your pocketbook could be directly impacted by this Republican stunt.
Well, President Biden there offered no guarantees on whether the U.S. would avoid exceeding its debt ceiling within the next 2 weeks. He says it's up to Mitch McConnell blaming the Senate Majority Leader for a so-called meteor headed for the economy. Well, joining us now is Bloomberg's Bruce Einhorn. Bruce, thank you for joining us. Always talking about U.S. politics. So the issue seems very urgent. How urgent is it?
Treasury Secretary Janet Yellen has said the government will run out of cash by around October 18th. Other observers say there may be an extra week or two, but either way, by the end of the month, the cash will be gone, according to most experts. So something's going to need to happen. Chuck Schumer, the Democratic leader in the Senate, is planning on a vote on a bill that has already passed the House that would suspend the debt ceiling until the end of next year. The Republicans have already blocked two versions of that earlier, and Mitch McConnell has said that they will not approve this one.
Right, so what happens next? Is there a timeline of how you see events unfolding?
That is a good question. So what does happen next? So McConnell wants the Democrats to solve all this through reconciliation. That's the budgetary procedure that doesn't involve the filibuster. The Democrats could do it with 50 votes plus Vice President Harris breaking the tie. The problem is that that's a lengthy process. It could take several weeks. And it's complicated. The Democrats are saying, no, we're not going to do it that way. So we'll have to see who blinks first. Meanwhile, we've got President Biden, who seems quite frustrated about this and is pointing out, because he wants everybody to know, that this is something that the Republicans have an obligation to help, he says, because they ran up about $8 trillion in debt during the Trump years, so that accounts for about a quarter of the total U.S. debt. So it's the president is saying you approved the spending, so now you have to approve the lifting of the debt ceiling in order to actually pay for it.
Bruce, thanks so much. Bruce Einhorn there, looking at all the intricacy of the debt ceiling and, of course, what we'll see in the next couple of hours, maybe days or weeks. Now let's get straight to your Bloomberg Business Flash. Here's Leanne Gerrits. Hi, Leanne.
Hi.
Actually, I think we'll get back to Leanne very shortly. We'll look at the markets. Of course, a lot going on in the tech sector. Yesterday, we saw a sell-off in the U.S. It's all about inflation. And then we'll have also a look at what we're seeing in high-yield credit in the U.S. Coming up, we'll have plenty more in China. We'll have plenty more on Fantasia and Evergrande. This is Bloomberg.
Of the Greek economic debacle. What were you thinking about to make Greece recover as it has?
Well, Tom, we took over in July 2019 with a very clear mandate to make the economy grow again. We were hit by the pandemic, but we still managed to implement very significant reforms. And I think we used the fiscal room that was available to us to support the real economy. We're very encouraged by the recent data. The economy grew 16.2% in the second quarter of this year. We revised our forecasts upward to 5.9%, and this may be a pessimistic forecast for 2021. We see lots of interest for foreign direct investment by American companies, European companies. We're making big progress in digitizing the state. We have a very ambitious green transition plan. And overall, I think the mood in the country after 10 years of crisis has significantly changed.
A lot's happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
we've got the information and insights.
David, you just hit the nail right on the head.
From business's most influential and instrumental.
I support the new framework.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in Paris. Now let's get straight to your Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Chipmaker Global Foundries has filed for an IPO. It's looking to capitalize on the chip boom amid a severe shortage of semiconductors. The firm is owned by the investment arm of the Abu Dhabi government called Mubadala. Bloomberg previously reported it was looking to value the business at around $30 billion. Another Chinese developer has fallen in crisis after failing to repay a maturing bond worth over $200 million. The problems at Vantasia are adding to the strains facing the nation's heavily leveraged property firms. Vantasia poses fewer risks to the broader markets than Evergrande, which is facing what could be one of China's biggest restructurings. JP Morgan is banning business travel and in-person meetings for employees who aren't vaccinated. It also says the unvaccinated will face higher payroll deductions to cover the cost of testing and health insurance. Wall Street banks have been adjusting their rules as they continue their push to bring staff back to the office. And veteran hedge fund manager Ken Griffin has a warning for younger employees. You're risking possible career advancement by continuing to work remotely. The Citadel chief says working outside the office also hinders innovation. He thinks working from home could cost us dearly over the next few decades. And that's your Bloomberg Business Flash. Francine.
Leanne, thank you so much. Now, this is what we're looking at. The activist fund engine number one has taken a stake in GM. The chief executive, Jennifer Grancio, said GM chief executive officer Mary Barra is making excellent decisions and that the company is on the right track. Well, Grancio spoke with Bloomberg's Romaine Bostick, Caroline Hyde, and Shanali Bazak.
GM and Exxon are two very different cases for us. So at engine number one, we believe that companies have to look at their material impacts and take that into account because impacts a link to long-term economic value. So in the case of General Motors, we think Mary and the board and the leadership team at GM is doing exactly the right thing. And so this is a position for us where the company is making excellent decisions about how to understand impacts, change that's coming from a climate perspective, and is looking to scale a battery and electric business to actually take advantage of being a leader on the other side of the change. So a very different scenario, and we think GM is on the right track.
Jennifer, is GM the only one on the right track? It's interesting that you take sort of an incumbent and a company that's pivoted entirely, a legacy business almost, rather than, say, Tesla, which is the one that, well, some other key females in the ETF sector have always loved, or indeed Ford's doing its own. Do you think that you'll broaden your viewpoint on some of the other key auto companies?
Yeah, our point of view is that there's huge value in these incumbent companies changing the way they do business. And so if we take Tesla, for example, they have been on battery and electric, that's their core business. But from a manufacturing perspective, they make a certain number of cars a year. Then let's take General Motors. General Motors has for a long time been doing research in this area, so they have a lot of intellectual property. And they've been making investments and will make more investments in real scale around battery technology. So GM makes 9 million cars a year. And when they make a transition to totally electric, they're having a huge scale impact. So to your question, yes, we look at companies that are already big incumbents. But when they get it right and they can figure out how to drive these innovations to scale, we think there's huge value. And in the incumbent space, some of the companies that do that first probably will gain the most from a market share gain perspective over time.
I'm curious about what you think about GM overall. And do you share any concerns about GM, particularly with some of the missteps we've seen with the Bolt EV battery and recall?
Yeah, I mean, our perspective is that innovation takes time, and GM has been invested in learning in this space for a lot of years. And so, in a sense, who better to have learned from things that have happened so far? Who better to scale this technology going forward?
Engine number one Chief Executive Jennifer Grancio speaking there to Bloomberg's Romain Bostick, Caroline Hyde, and Shonali Bazik. Now let's take a look at some of the things that we'll be watching out for today. Later this morning, 10 a.m. UK time, we'll have some euro area data, including PPI. EU finance ministers are also in Luxembourg for the Union's Economic and Financial Affairs Council. Proceedings kick off at 11 a.m. UK time. We'll also have some data today from the US beginning at 1:30 p.m. UK time, including trade balance as well as services PMI. Now, at 3 p.m. UK time, the OECD 2021 Ministerial Council meeting starts. The two-day event will be chaired by the US. I'll be actually moderating a conference, a panel on the Blue Dot Network, talking about the US, its rivals, and of course what it can do with China as well. Anthony Blinken, the US Secretary of State, will be joining me. This is what the markets are looking at now. We are seeing a rout in technology stocks that's easing somewhat. If you look at the contracts on the NASDAQ 100 index, rising now some 0.4% after the underlying index plunged to the lowest level since June yesterday. I'm looking at more calm in global markets, being shattered by a growing wall of worry spanning a debt in China, but also spanning elevated inflation on the back of this commodity supply shock and also fading economic recovery. The U.S. political bickering is still at the forefront. If you look at the turbulence, it comes even as investors brace for tapering of stimulus by the Federal Reserve. Well, Bloomberg Surveillance Early Edition continues in the next hour. I'll be joined by Danny Berger in London, Kaylee Lyons in New York. Again, we have a full roundup of everything we've seen from the markets to energy crisis, to some of the high yield credit that we're also seeing in China. This is Bloomberg.
Something wrong with her eye. And when I had a look, it looked like she was blind. The vet that she's registered with were only doing telephone appointments, which was a bit pointless because she really needed to be seen by someone. And I couldn't get one anyway for like another week. I was just quite worried about, you know, the complications of leaving it for so long.
We've seen millions more animals becoming pets in the past year due to the people having increased time at home. What we're also finding is due to Brexit that we're having decreased numbers of European vets working over here. So unfortunately, we're unable to meet that current demand for pet services. Also, COVID's got the inevitable impact with people having to self-isolate.
It
is very limited what we can diagnose, so it's more about peace of mind and determining whether they do need to be seen in person.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
That is the only mandate of the Fed, price stability and full employment. And let's be clear, right now we don't have price stability.
The fourth quarter is going to be very tough. Big picture, still optimistic. Business cycle is set to be a good one.
I think the near term is a little more treacherous, but we don't have the signs of a recession. Unless we have a recession, it's hard to see a big down move in the market. So I think we're going to tread water with a lot of volatility in both directions.
This is Bloomberg Surveillance, Early Edition, with Francine Lacqua, Matt Miller, and Keely Lines.
It's 10 a.m. in London, 11 a.m. in Berlin, 5 a.m. in New York, and 5 p.m. in Hong Kong on this Tuesday, October 5th. Our top stories today. Facebook finds fault. The social network blames the huge outage on a change in its network configuration. President Biden does his own blaming. He warns the U.S. could breach the debt ceiling in 2 weeks, says it's the fault of Republican Senate leader Mitch McConnell. Another Chinese developer has fallen into crisis. This time it's Fantasia, which failed to repay a $206 million bond that was due. I'm Danny Berger in London alongside Francine Lacqua in Paris and Kaylee Lines in New York. Matt Miller is off this week. And Francine, you are so missed in the London studio, but you have a really exciting schedule ahead of you in the OECD forum there in Paris, speaking to Secretary Anthony Blinken as well.
Yes, of course, it's U.S. foreign policy, left, right, and center after Emmanuel Macron took it extremely badly. That, of course, they were snubbed on the submarine deal. So this is, I guess, the U.S. chance to make amends or to explain their strategy with allies, including with or without China. And that, of course, will filter through market movement.
Right, and of course, in terms of trying to make amends, Kaylee, is it a turnaround Tuesday after a pretty ugly session yesterday?
Maybe that's the case in Europe and the U.S., Danny, but it certainly was not the case in Asia. Of course, Chinese stock markets are still closed for the holiday, but we had down days a lot of other places, including in South Korea and Japan, where stocks fell around 2% each. Actually, the Kospi falling into a technical correction, and the Nikkei 225 in Japan is just a few tenths of a percent away from falling into one. You did see some resilience for Hong Kong stocks, though. The Hang Seng up about 0.25%, though property stocks within that index did fall. Of course, it's not just Evergrande we have to worry about now, but Fantasia missing that bond payment yesterday. The contagion is spreading, and that is really putting pressure on Asian dollar bonds, which had their biggest drop for high-yield bonds going all the way back to 2013. Also in foreign exchange, I would point out the Kiwi, the big underperformer in G10 today, weaker against the dollar by about 0.1% ahead of the RBNZ policy decision tomorrow. As for the picture here in the U.S., as Danny alluded to, it was a deeply negative day for stocks yesterday. Actually, the S&P 500 falling to its lowest level since July. The NASDAQ 100, its lowest level since June. But we are seeing signs of a rebound this morning, though a tentative one. Right now, S&P futures are up about 0.3%. Steady as she goes in the bond market. That may be helping risk sentiment today. The 10-year yield sitting right around 148.76. The dollar is stronger on the day, maybe getting a little bit of a remaining haven bid. And then I would just point to oil at its highest since 2014. Danny, OPEC Plus sticking with its plan, 400,000 barrels a day production hike in November, not giving into temptation, even though oil prices are on the highest in years, Danny.
Well, certainly some of those higher oil prices is helping the energy sector. Of course, we have a lot of the oil majors listed in London. You can see the FTSE 100 up 0.5%. But generally, we're seeing a stronger market here in Europe, snapping 3 days of losses. This is a pretty orderly gain, given that more worse session when it came to the Asian session, which Kaylee, you highlighted. Usually you'll have Europe pick up a tinge of that negativity, especially because China cracking down rather on luxury space, making a lot of speculation around there. Doesn't seem to really be hurting France too much. This is up 0.6%. Really, the leader, though, in today's market is Italy. We're looking at a FTSE MIB up 0.9%. Let's switch up the board so I can show you why it is that Italy is gaining so much. And it's because the bottom of the board here, it's a stock 600 banks. This is the best performing sector so far today. That's up 1.6%. Italy dominated by the banks in the region. So this is a story of trying to contain some of the fallout when it comes to higher inflation, higher rates. You buy banks as a hedge of that. Now, in terms of that higher inflation, higher rate story, you can see natural gas on the top here. It's that energy crisis not giving up. The price of natural gas in Europe skyrocketing yet again today, up 13%, crossing the threshold of 100 euros at its highest price on record at 109 euros and some change. Germany break-evens also at another record, only up about 3 basis points, but still moving higher beyond 1.74. Finally, some weakness in the euro dollar. This really is a falling yield play. However, of course, stronger king dollar certainly helping push down the euro as well this morning, Francine.
Yeah, Danny, I love the fact that you actually looked at European banks. I think there was a note by JP Morgan this morning saying that they will benefit, of course, from dividends now that they can pay it out. They will benefit from rising bond yields and possible re-rating. Now, this is what is going on ahead today. First of all, Tokyo hosting the TCFD summit to discuss climate-related financial disclosures. Now, the Bank of Japan Governor Haruhiko Kuroda is amongst the speakers. Also, European finance ministers meet in Luxembourg amid the worst energy crisis that the bloc has seen in years. The OECD 2021 Ministerial Council meeting starts today. Speakers include the Secretary General, Matthias Cormann, and the U.S. Secretary of State, Antony Blinken. This is why I'm in Paris. And then Microsoft Windows 11 and Office 2021 launches. Now, this comes as the company's shares have come under pressure this month. Onto the energy crisis and, of course, the tech crisis. Facebook's Mark Zuckerberg has apologized for a global services outage that kept its social media apps offline for much of Monday. We've never seen anything like it. The world was in meltdown. Let's get the latest with Bloomberg's Laura Wright. Laura, could this happen again?
Hi, Francine. Well, it was a network configuration which led to a global outage of Facebook's key platforms, Facebook, Messenger, Instagram, WhatsApp, affecting 2.7 billion users. Now, as you mentioned, Mark Zuckerberg was led to apologize. Engineers actually had to go on site to the servers to physically reset them. Now, many users flocked to alternative platforms such as Signal, which is non-profit. A key proponent of that is Twitter's CEO, Jack Dorsey. But it raises concerns about dependency on one platform.
Yeah, absolutely. And I really struggled with nothing to check all afternoon yesterday. Laura, it would be great if this was Facebook's only problem, but it's not. There is a whistleblower from the company who is testifying on Capitol Hill today about it prioritizing profit over people. Just how consequential could that testimony be?
Very, Kaylee. Well, Frances Haugen gave an interview to CBS 60 Minutes on Sunday evening. Now, when Facebook opened yesterday, it was actually that interview which put pressure on the stock and meant it was already trading down over 4% before the outages were announced. As you can see in pre-market trading, Facebook up 1.6% right now, demonstrating some recovery. But Haugen will be speaking to a Senate subcommittee later today about privacy, about the frightening truth behind Facebook's opaque management structures. So definitely worth keeping an eye whether there'll be more downside for Facebook later today.
Yeah, and if there's any more regulation coming down the pike. Thank you so much to Bloomberg's Laura Wright. Now heading over to Washington, in a speech from the White House yesterday, President Biden demanded that Republicans stop blocking Democratic efforts to suspend the debt ceiling, a legislative battle that's brought the U.S. government to the brink of its first ever default.
The Republicans in Congress, what they're doing today is so reckless and dangerous in my view. As soon as this week, your savings and your pocketbook could be directly impacted by this Republican stunt.
Anne-Marie Horder, and Bloomberg Washington correspondent, joins us now from D.C. So, Anne-Marie, Chuck Schumer says he's going to put a debt ceiling lift to vote in the Senate this week. Republicans have promised to shoot it down. If it fails, what is the course forward in terms of getting the debt ceiling lifted before the Treasury runs out of money?
It's a great question. Senator Schumer yesterday invoked cloture in the Senate. This was the House-passed bill on the debt ceiling, but he needs 60 votes. And how are you going to get 10 Republicans when you have Senator Mitch McConnell writing a letter to the president saying the Republicans will not go alongside you on this? The Democrats need to do it alone, and we've told you for weeks you need to do it alone. So what's going to happen next is someone has to blink. Either there needs to be enough Republicans to come on board and allow this to go through. You would need all the Republican senators to at least agree to allow a simple majority vote to go through, and that's very, very unlikely. So then the Democrats are going to have to try to go through this via reconciliation, the same path they are using for their $3.5 trillion spending package. They're going to have to do that to raise the debt ceiling. The issue is experts say that takes about 2 weeks. Now, we're now 13 days away. So if they're going to do that, they need to move very quickly.
I was going to ask you, Anne-Marie, in terms of timelines, what kind of timeline are we looking at? Is it, 2 weeks and the meteor hits, as the president has called it, the economy?
The issue with the debt ceiling is you don't know exactly when it will all stop and turn off in terms on defaulting on the debt. Treasury Secretary Janet Yellen has marked out that the Treasury deems this day to be October 18th, but even in that letter she wrote to congressional leadership, she said it can move forward or backwards. So we are getting very close to the quote-unquote brink of defaulting on our debt, which Moody's Analytics has said could be catastrophic, not just to the U.S. financial market, to the global financial system, but also millions of jobs. A mini recession can incur on this, all while we're still dealing with a pandemic. So the timeline for the Democrats, though, Francine, to answer your point a bit more directly, to use reconciliation would be they would need to begin it today, within this week. And what also is a little bit uncomfortable leading up to the debt ceiling is that the House is out of session for 2 weeks and the Senate is off next week as well. So this is a really crucial week in Washington.
Right, of course, perhaps markets waiting till closer until that deadline to have any sort of reaction here. Anne-Marie, thanks so much. That's our Bloomberg's Anne-Marie Horder. Now, another Chinese developer is falling into crisis. Fantasia failed to repay a nearly $206 million bond, adding to the strains of the nation's heavily leveraged property firms. Bloomberg's Tom McKenzie joins us now. So, Tom, first Evergrande, now Fantasia. Does this suggest that the stress in the property sector in China is spreading?
It is spreading. I mean, this is clearly evidence of it. Fantasia is a much smaller company. That is the caveat in terms of its liabilities. You're talking about $13 billion US versus $300 billion for Evergrande. So that's the context. It's number 60 in terms of contracted sales versus number 2 for Evergrande. But absolutely, this is partly as a result of that contagion. We've seen the yields on those offshore dollar bond notes for these property developers spiking well above 15%. And of course, the regulations put in place that started last year by the Chinese government to try and rein in the borrowing of some of these highly levered companies. So that is the context. Whether or not, of course, they're able to secure the spread is what's going to be in focus, and where we are in terms of the restructuring, if it comes, for Evergrande as well. And the question mark for investors is how much hidden debt as well, because I talked about the $13 billion of liabilities for Fantasia, the appropriately named property developer there, and $300 billion for Evergrande is the stuff that's hidden that is a concern as well for investors.
Well, Tom, China isn't just dealing with a property sector crisis, it's dealing with a power crunch as well. And China has ordered banks to prioritize funding to boost coal output. How does that run counter to China's environmental goals?
Well, that's a really good point, and it's exactly why you've seen an energy crunch, not just because of those regulations, also, of course, energy prices globally rising, but it didn't help, essentially, that China was putting in place curbs earlier in the year to try and meet those carbon emission goals. Even if those are admirable, it's left to this energy crunch, particularly in the northeast and southeast of the country. You've seen most regions having to cut back. That led to what we saw in terms of that manufacturing PMI, the first contraction for factories for China since the pandemic. You've seen downgrades for the outlook for growth as a result of that from the likes of Goldman Sachs and Nomura. Now, as you say, officials leaning on the bank saying, look, you've got to spend more, or at least lend more, I should say, to those energy companies, to those coal companies, so they can up production to ease some of these energy constraints. So that pressure remains. The banks having to juggle their contagion or their exposures to the property sector, and now being asked as well to support the energy sector amid these very, very high energy prices.
and being told they can't use lending to speculate in commodities. Thank you so much to Bloomberg's Tom McKenzie. Let's bring it back to the U.S. now and take a look at some stocks moving in pre-market trading. And of course, we talked about the outages Facebook was dealing with, but Twitter had some of their own reported yesterday, and the stock fell nearly 6% as a result. Some people, though, may be taking advantage of that dip to come back in and buy. The shares up about 1% in pre-market trading this morning. Another upside mover is Ocugen, the biotech company. This is on reports, the company saying that it has reached an agreement with CanSino to use one of its gene therapies for an eye disease. Plus, it also has reached a supply agreement on a COVID-19 vaccine. So that stock is up about 7% before the bell. One mover to the downside, though, is Albertsons, the grocery company. It got cut to underweight at BMO with a $26 price target. That's well below the $30 a share it closed at yesterday. This morning it's trading right around 29, down about 3.3% before the bell, Francine.
Kaylee, thank you so much. Now we'll have plenty more, of course, on the markets. We'll look at this wall of worry, including what we're seeing with inflation, high-yield credit in China, and, of course, global GDP. Coming up, a conversation with Laurence Boone, the OECD chief economist. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
This is Bloomberg Surveillance Early Edition. I'm Francine Lacroix in Paris, Danny Berger in London, Kelly Lyons in New York. Now let's get straight to the market and, of course, to the economy. The OECD 2021 Ministerial Council meeting kicks off today. It's the organization's highest level forum, attended by ministers of finance, economy, foreign affairs, and trade. Well, joining us now from the conference is Laurence Boone, chief economist at the OECD. Laurence, great to speak to you. You've always been a great student of inflation. You've, of course, warned on some of the debt out there and the prescription for Europe to move forward. When you look at the wall of worries in the markets right now, it's China, high yield, the concern that actually could be a Lehman moment, and then everything that we have to do with inflation. What's your top one worry right now?
So thank you, Francine, for the invitation and for being here for the ministerial with us. One of our biggest concern is obviously inflation after the health crisis. Also, we would urge to actually look at the various factors explaining what's going on. We do project inflation will continue rising for a few months, but that it should start taming off. And that's for a few reasons. The first one is one of the things driving inflation, as you were saying, it's shipping cost. And that's some disruptions that stay with us from the virus. So that should go as the health situation improve. Other thing is we're seeing some wage growth in some sector, but they're usually hotel, restaurants, and sectors where low qualified, low paid people were high proportion, and it's actually quite good that they're seeing their wage rising. And you were mentioning earlier on energy prices. This is part of an adjustment, right? It's a one-off in prices. That doesn't mean that they will continue to rise forever.
But Laurence, so is there a danger that actually central banks are doing a policy mistake by continuing, believing and telling the markets that inflation is transitory?
So the central banks have the toughest job of all at the moment because they must distinguish between what's temporary, what's more structural. Obviously, I think temporary, when we talk about the disruption from the virus, it can be 12 months or 18 months. What's super important at this stage is actually to make sure that we are seeing some shift in wages where it's needed. But we're not seeing this wage price spiral where people get scared because some prices are rising. They ask for wage increases. Firms saying that then push up their prices. Then people ask even more wage increases. That's the type of spiral that we really don't want to see. And for this, I think it's super important that central bank clarify how and when, under what condition they will act to keep, inflation expectation anchor and avoid this type of slippage.
Laurence, it's Kaylee in New York. I want to pick back up on the energy crisis, which you mentioned. Even if prices don't stay this high forever, could they stay high for long enough that it means you have to reevaluate your growth forecasts?
So if I knew that, I would probably be very rich and on the market. But more seriously, I think what we're seeing is effectively some shortages, and that creates price increases. It doesn't mean that they will last throughout. But I think what's important to take away from this, it's really what's happening with energy transition, because there's been a lot of talk about it. We're seeing how energy prices are moving. Now we must address the fact that we need to shift from carbon energy towards decarbonized energy sources. And that's going to take a change in the price and quantity of what we're consuming. So today it's oil and gas, and we need to move away towards more renewable towards more renewable energy, and that will help prices tame down.
Well, we know that China was trying to prioritize more renewable energy sources and has now told coal producers to ramp it up because of the power shortage that they are dealing with there. And that's not the only issue in China. You also have a broader economic slowdown, some crisis in the property sector. How worried are you about the potential ripple effects from China to the rest of the world?
So as you know, so that's a really good question. As you know, China has contributed to about a third of the global economic growth, which is very significant. So we cannot ignore what's happening in China at all. Now, when we look at, for example, the property market, we at the OECD, like other international organizations, have actually warned that, when the growth engine is too much residential investment, it is not sustainable. And Chinese authorities have been trying to move away from this type of investments and to encourage consumption in China. So that's not happening. They need a better social security system to encourage consumption. And obviously the housing market will slow. I would about to say, it has to be a soft landing. It has to be cleaner of credit risk. It's usually bumpy soft landing, but we are confident the authorities have the fiscal and monetary space to actually manage it and avoid too much spillover outside of China. But yeah, this is definitely something to watch.
Well, Laurence, when you have this dynamic in China, you have other idiosyncratic issues with other nations, be it their pace of recovery from COVID, be it the energy crisis. How far away are we from seeing any sort of synchronized global growth? So
we had this synchronized global rebound, right? And when you look at it for the world, we've nearly wiped out the effect of the crisis on GDP. That's a very remarkable achievement. But I really like your question, because to have this sort of synchronized global growth, you actually need discussion between the global power. You need coordination of their economic policies. And that is very much what we're trying to do here at the OECD, and that this ministerial council is pushing forward, including on digital taxation, including on climate, and including on how to coordinate a stronger and more sustainable recovery.
Laurence, we're getting quite a lot of questions from viewers asking about how governments should deal with the debt they've amassed during the pandemic. Do they need to go look at financial repression, austerity, or just surrender their budget to central banks?
So it's true, we've seen a massive jump, as you said, in public debt. Now, there's one thing I would like to, we would really like to convey today, which is that, there is no magic number for debt sustainability, right? Japan has been living for a very long time with 200% of GDP debt. But conversely, some emerging market economies may run into default and into solvency issue with 35% of GDP debt. What I think is very important, and what we're working on at the moment, is to ensure that both spending and taxes are not only sustainable, but directed at priorities and endorsed by their democratic people. And the sustainability, the faith that it reflects people's choice, it's taking into account long-term issues like aging, and that there's a strategy which is transparent behind it, that is endorsed by investors. That is what makes a debt sustainable. What we've said is, support your economy during the crisis. Now that we're getting out of it, it's the time to better target the spending, and also not to engage into excess spending in a structural way that would put debt into danger.
Laurence, thank you so much for your time. As always, Laurence Boone, their chief economist at the OECD, talking to us about a range of things, including, of course, the debt, how you deal with China, and everything in between. Now let's get straight to the Bloomberg First Word News, and we start with JP Morgan Chase rolling out new measures to prevent coronavirus infections. Now, the bank has banned business travel and in-person meetings with employees who have not been vaccinated or won't disclose whether they've had their shots. Unvaccinated employees also will face higher payroll deductions to cover the cost of testing and health insurance. Now, in Manhattan, apartment sales soared in the third quarter to their best showing in decades. Closed sales totaled more than 4,500, well, according to appraiser Miller Samuel and broker Douglas Elliman Real Estate. That's the most for any quarter dating back to 1989. Buyers are acting fast and paying more as last year's COVID discounts have gone away. Now, coming up, Freddie Late, founder and chief investment officer of Latitude Investments, a conversation on markets. I'll leave you in the capable hands of Kaylee and Danny as I'm going over to the OECD for a conversation with the Secretary of State, Antony Blinken, a conversation that will be on China and, of course, how he also deals with its allies, including France. This is Bloomberg.
as Magnus TV in Facebook since I'm streaming Axie Infinity. Axie Infinity is an NFT game where you can earn tokens, and then that tokens can be converted into pesos. I'm playing almost 4 to 5 hours a day. I'm earning, I can say it's really a lot of money. It can help to sustain my family needs and also to sustain my own business that I'm starting. I'm a little bit worried about it because some people who join this Axie Infinity thinking that this is an easy money game. They can earn a lot on this game. This game can sustain their life. And I think that is not the point, or that is not really the game. We are trying now to build a community where other players or my scholars can join this esport, playing Axie Infinity for now, even 5 years, I think.
Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lines in New York. Perspective on the day ahead. Bloomberg Surveillance, Early Edition. Weekday mornings on Bloomberg Television.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London alongside Kaylee Lines in New York. Matt Miller's off this week, and Kaylee, Francine has just left us for a cracking panel at the OECD conference. Anthony Blinken will be part of it, but in the meantime, we just have that fascinating conversation with Laurence Boone of the OECD, who says inflation risks in her mind are going to start to tail off.
Yeah, it seems that the market may be buying more the whole inflation is transitory kind of thesis, but that doesn't mean that we're seeing really robust risk sentiment. Yes, we are seeing some buying of yesterday's dip coming in, Danny, but it isn't the strongest dip buying we have ever seen. Stocks are in positive territory in Europe to the tune of about 0.6%, so they have recovered yesterday's losses. It's really banks and technology leading the way in Europe, and of course it was technology that was the big underperformer here in the U.S. yesterday. The NASDAQ 100 falling more than 2%. To its lowest level since June. But this morning, it is actually big tech futures that are outperforming the most. NASDAQ 100 futures up about 0.5%. Probably helped out by the fact that yields aren't moving materially higher this morning. We're up less than a basis point on the U.S. 10-year yield, sitting at 148.59. And I would point to the commodity spot index as well, the Bloomberg Commodity Spot Index at a record high. On the one hand, you have oil at the highest since 2014. You also have surging natural gas prices because of the energy crisis, and of course, just higher demand for raw materials in general. Now, with that move higher in commodities, specifically oil, you are starting to see energy outperforming in pre-market trading once again. The likes of Devon Energy, Marathon Oil, each up between 1% and 1.5%. And then, of course, the other story of yesterday was the outages at Facebook and the whistleblower testifying on Capitol Hill today. Facebook fell about 5% yesterday, but some buying of the dip coming in this morning, up about 1.5%. Twitter had outages of its own, also fell 6% yesterday, but once again, shares in positive territory in early hours, Danny, up a little more than 1 percentage point.
All right, I can't get off of this tech theme because it was such a consequential move yesterday. So I want to stick on it, perhaps look into some of the technicals. I want to welcome our radio listeners as well. I have a chart in front of me that I will explain to you as well. It is a very simple line graph of the NYSE FANG Plus Index. So this has all of the usual suspects of FANG plus NVIDIA, the other large cap tech. And I also on here have its 200-day moving average. And I have them both here really just to emphasize the degree of the fall in tech yesterday. We nudged right up to that 200-day moving average with about a 3% decline in this NYSE FANG index. The last time we saw it fall below was in March of 2020. So this really reflecting a lot of the carnage we saw during the beginning of the pandemic. Of course, this picture is really consequential for the entirety of the benchmark itself. This is about 20% of the S&P 500. And if these didn't even exist in the S&P 500, the main equity US benchmark would have halved its losses. So what do you do? Well, this continue to fall further? Will there be any dip buying? Well, let's get to our next guest who knows a thing or two about big cap tech. It is Freddie Late, CIO and founder at Latitude Investment. Freddie, first off, thanks so much for joining. So in both your Horizon and your global fund, you own Alphabet and Facebook within the top 10. So were you a buyer on this dip yesterday?
Good morning. Yes, I think we have been a buyer on this dip, and I do believe that Facebook's trading at an incredibly attractive valuation, as is Alphabet. Both very interesting shares to own, and I think you can own both within a diversified portfolio. Obviously, Facebook yesterday had suffered from bad headlines, the outage, the whistleblower around some of the social concerns, which I believe they're addressing head on, and also from a sector and style rotation. You know, as interest rates have been rising, we've seen the kind of long duration big cap tech getting hit. And I think while there's a lot of overvalued stocks in that kind of environment, stocks like these are actually very well priced given the growth they should generate for clients. So we're happy buyers at these levels, yeah.
But these aren't the only mega cap tech stocks. And as you say, many of them are much more richly valued. Can you be bullish the equity market if you think some of those other more richly valued names may underperform in a higher rate environment?
I think it's quite tricky to be bullish on the overall equity market if you think there's an environment where those large cap tech stocks and the broader long duration high quality growth defensive growth stocks are likely to fall over, because it's probable that's an environment of interest rates expectations rising, at least if not rates themselves tapering, and maybe some inflation being a bit more stubbornly persistent than expected. In that environment, I think overall valuations are likely to fall as well as some of the more richly valued tech stock. And I think it's very difficult to see the market marching higher in that environment. And that is probably what I expect, along with harder earnings growth and GDP growth indeed next year. So I think we are entering quite a difficult phase for the market, and it's tough to see it going up without that tech leadership.
So does that mean it's time to pull back on equity exposure and readjust your asset allocation, Freddie?
Well, it's a really hard question because stocks are still more attractive than bonds at the current level of bond yields, especially on a real yield basis. You know, you will make a real positive return from a long-term holding in a portfolio of equities at this level, whereas you won't if you buy and hold a conventional government bond. So I think you'd need to see an actual move higher in interest rates to drive the relative value back towards bonds. And I think it needs to be a few hundred basis points of move. So I think you've got a cushion to owning equities for the long term, but I just think if you're thinking shorter term about it, I imagine the next quarter is going to be pretty choppy and with far more risk to the downside, unless we see a reversal of the central bank policy, sorry.
Sure, no, totally fine. So a few hundred basis points, I mean, that is a pretty large move when it comes to treasuries, but could we see something like that? How much further do yields have to go in terms of their upward trajectory?
Yeah, I think at the moment, if we're talking for the next sort of 6 to 18 months, I think it's going to be far more about the speed with which interest rates move than the level. I'm not suggesting interest rates are going to hit 3.5% anytime soon. Or that's yields, 10-year yields. Interest rates, certainly not. But I do believe the speed with which they move will have a major impact on the sort of factors and styles within the market, and therefore, to your earlier question, the market level overall. The faster we see a move higher in interest rates, even if in the US they go to 1.75 or maybe up towards 2 on the 10-year, I think if that happened rapidly in the next, say, 6 weeks, we could see a meaningful pullback in the market of 10, 15%. I mean, let's not forget this move we saw yesterday took the cumulative fall in the S&P to just over 5%, the first fall of that magnitude this year. Yeah. It's been a very, very easy run so far, and it would be a huge surprise to expect more volatility.
Yeah, definitely good context to put in there, Freddie. And of course, that move higher, the pace of which has already affected equity markets. One thing, though, that has confounded many is that high yield spreads have remained so thin. Why haven't we seen some of the concerns spill over into that risk market?
Well, at the moment, the reason why we're seeing inflation, which is what's driving rates higher, is a demand pull. All of the government stimulus on the fiscal side has really driven, stronger consumer balance sheets, stronger corporate balance sheets, and this extraordinary demand coming through a supply chain where there's a huge amount of friction. And so in that environment, it's a positive economic environment. You wouldn't expect to see high yield sort of risk premia going higher. it's not that we're pricing in a massive slowdown or recession next year. It's sort of the opposite, that the party may be coming to an end because inflation and rates and tapering all have to happen, because economic growth is reasonably strong, in fact, very strong. So I think that's why you haven't seen high yield spreads moving higher yet. And I don't anticipate they will unless we see a contraction in economic activity.
Freddie, we're only about a week away from earnings season. It's really quite hard to believe. And you have the likes of Morgan Stanley warning that earnings may not surprise to the upside to the degree we've seen over the last year or so due to a lot of the supply chain pressures that are out there. As we head into this earnings season, how concerned are you about profit margins?
Reasonably concerned at an index level, and certainly for some of our individual names as well, although we believe they can ride through it. I think, with ROEs and profit margins at record highs in the US market in particular, but around the world more broadly, and I'm not surprised Morgan Stanley is saying we can't beat earnings as much as we have in the past 6 to 9 months, because it's been extraordinary, the level to which all companies across all sectors and regions have been beating earnings and really pulling through very, very strong numbers. I think you are likely to see a slowdown in the top line, an increase in the cost of goods sold, an increase in the wage line, and probably a little bit more pressure for potentially around taxes and subsidies and furlough schemes rolling over. The offset would be one-off COVID costs going away, but it won't be enough to stop that squeeze on margins. And so I do believe you'll have less operating leverage, more cost inflation, and it's unlikely to see what you need, which is higher pricing at the revenue line coming through for another 6 to 12 months. So I do think you'll see a lot more misses, a lot more downside volatility, and generally supply chains really being the feature this earnings season.
Supply side problems seem to be everywhere. Thank you so much for your valuable insight this morning. That's Freddie Late, CIO and founder at Latitude Investment. And coming up, speaking of supply issues, the transition to clean energy may be a cause of decades of crises like the ones we are seeing now. More on that from our big take next. This is Bloomberg.
Watch Bloomberg Surveillance to learn how to look at markets, how to look at trends, and how to look younger.
What do you think, John? Botox, or do I really need to get something done?
I think, Tom, if we just change the style up a little bit.
You think so?
Yeah,
You look
drop
great.
the bow tie. Drop the bow tie.
What,
Drop
skinny
the bow
tie?
Yeah. I always say, this is my line, whenever anyone in America has a go at me about a skinny tie, the older you get, the wider it gets.
Oh, really?
Until it becomes a bow tie.
This is a bow tie.
Until it becomes so fat, you just sort of...
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
What we're seeing is effectively some shortages, and that creates price increases. It doesn't mean that they will last throughout, but I think what's important to take away from this, it's really what's happening with energy transition, because there's been a lot of talk about it. We're seeing how energy prices are moving. Now we must address the fact that we need to shift from carbon energy towards decarbonized energy sources.
OECD Chief Economist Laurence Bon speaking to us earlier. Let's stick with the energy and the energy crisis story. The world is living through its first major energy crisis of the clean power transition. The next several decades could see more periods of energy-driven inflation, fuel shortages, and lost economic growth as electricity supplies are left vulnerable to shocks. It's our big take today. You can access it by going NI Big Take on your terminal. Let's dig more into this. Joining us now is Todd Gillespie, Bloomberg's Power and Renewables reporter. Todd, thanks so much for joining us. So first off, the question on the top of everyone's minds as we see the energy crisis unfold, how much longer does this have to run?
Well, that's the question that everyone really wants to know the answer to right now. But really, I mean, this is a volatile story for the entire energy transition, quite possibly. And it really just kind of underlines the urgency for governments to go towards backup sources of energy which are more stable, more reliable, make sure that our renewable energy mix is also kind of linked in with ideas about storage, making sure that we can plan ahead and not just rely totally on imports and all sorts of energy, which is also very dependent on all sorts of international flows and other countries' geopolitics as well.
Right. So then does this mean that this speeds up the transition to those more sustainable types of energy sources?
Well, that's the question that we should be asking governments right now. Boris Johnson is talking a lot about investing in hydrogen and nuclear in the UK in particular, wanting to sort of electrify all sources by 2035, or at least go towards non-carbon types of energy. I mean, we're looking at sort of removing our dependence from natural gas in particular, right? I mean, this is kind of one of the big marks, which is, when you don't have energy systems that are so volatile, so dependent on such a volatile source of energy, then you can sort of start talking about a more stable energy system, a more predictable energy system, and one that doesn't constantly feed back worries to consumers and to private companies as well.
Obviously, there has been a lot of investment recently, Todd, in renewable energy, in sources like solar and wind. And a lot of people have said that has led to just straight up underinvestment in legacy energy sources. How do we strike that balance going forward so that this doesn't happen again?
Yeah, that's right. I mean, Jeff Curry from Goldman Sachs was saying that the other day on Bloomberg. It's a controversial point, to be quite frank. I mean, there are some people who very much buy this thesis that sort of the old economy has been underinvested in. We've moved too fast towards investing in renewables and haven't really thought enough about stability during that transition. It's perhaps a fair point, but it also kind of underscores the urgency of actually, going faster and actually going faster towards more renewable sources in a more sustainable way, because frankly, this is going to cost money, but it's going to cost even more money in the long run if we don't do it, and we don't do it faster because of the impact from climate change and from all of these carbon-intensive energy sources.
What's the biggest barrier to doing it faster and to scaling up some of these renewable energy sources?
Batteries are one of those things, hydrogen development as well. A lot of these things are still in their infancy. Places like Australia and California are still already sort of rolling out battery technology to try and store solar and wind sources overnight. But some of these things only last for 4 hours, so you need you need a lot of coordination with the grid and different types of sources. So the science is really kind of being invested in heavily right now, but obviously it's not as reliable, and it's not we don't know enough about it relative to what we know about coal and gas that we've been using for decades. So that sort of, that sort of attention needs to be taken right now.
It's a brave new world. Thank you so much to Bloomberg's Todd Gillespie. You can, of course, find his Big Take story on the Bloomberg terminal and online. And coming up throughout the day, the Bloomberg Invest Global Conference will focus on the key issues driving institutional investment strategies. We'll hear from Grayscale CEO Michael Schonenschein, Brookfield CEO Bruce Flatt, and Soros Fund Management CEO Don Fitzpatrick. This is Bloomberg.
Do you have any mistakes you've made or failures that you can talk about so that people could feel you're not just a superhuman?
People ask that question as if the only challenge is at work. Challenges come in a lot of different packages.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
If you are early in your career, you are making a grave mistake not being back at work. It's incredibly difficult to have the managerial experiences, the interpersonal experiences that you need to have to take your career forward in a work remotely environment. Work remotely is very good at maintaining the status quo, but the world's not static. Competitive pressures from around the world will put American businesses continually under pressure. The Chinese have been back at work literally from almost the start. They're continuing to evolve at a very rapid rate of innovation. And we are, in many ways, stuck in patterns from 18 months ago because it is so much harder to create and to innovate in a remote working environment. So for our youngest members of our workforce, I'm gravely concerned that the loss of early career development opportunities is going to cost us dearly over the decades to come.
Citadel founder and CEO Ken Griffin speaking with Bloomberg's Eric Schatzker yesterday. And joining us now is Tom Keene, co-anchor of Bloomberg Surveillance, who is in the office. He has been in the office. Tom, when was the last time you worked from home?
I worked from home. It was really difficult technically. It was a great joy. And I won't mince words, Kaylee, as you well know as well. Bloomberg management has killed themselves to make it safe and effortless. I really can't tell you the luxury treatment, folks, we've had from day one. We did that, Kaylee, with, oil a little lower. We are beginning to migrate higher, and it gets your attention. Francine looks at Brent crude, 81.62. Let's go to what really matters, which is a gallon of gas. And let's go to the facts, not the angst that's out there. The pink line is the moving average that matters. That's your paycheck moving average. We have launched higher. We have launched out of the last 4 or 5 years on the edge of getting back to the angst that we saw of an average of $3.58 a gallon, somewhat up near that $4 level.
Tom, how do the pros in the equity space use this in terms of their inputs for asset allocations and earnings estimates?
It's really, really important question. Commodities trend better. That's the Commodities 101, Danny. They always trend better. So if you find the trend and take it over to your equity belief, maybe you can do better than good. I've had personal good experience with that. You've got to get on the trend. And the arch question now is a breakout in commodities. Looking at the Bloomberg Commodity Index, is that trend sustainable? And we're, of course, as you know, we're hearing from major houses they believe it is.
Yeah, Bank of America calling for $100 oil in the near future. Tom, obviously gas prices have been in part driven by the fact that we're seeing an energy crisis in many parts of the world, including the UK, Europe, China. We were speaking with Laurence Boone of the OECD earlier, and she said it's not going to last forever, so kind of look through it.
Well, I'm a huge fan of Laurence Boone's work. I knew her back at, I think it was Merrill Lynch years ago. And Dr. Boone and the others are looking at the supply and the the supply and the demand dynamics. And their belief is the supply challenges will go away. You call it an energy crisis. Is it an energy crisis or is it a supply crisis? Kaylee, an energy crisis is when your father buys a VW diesel that when you're on the expressway really can't get going and the guy in a BMW drives over you.
Nah,
that was the 70s.
My dad drives a 68 GTO. Forget a Beetle. Anyway, Tom Keene, co-anchor of Bloomberg
That was our
Surveillance.
lust car in high school.
Tom Keene, co-anchor of Bloomberg Surveillance, talking cars and all things gasoline with us this morning. Thank you so much. And now let's take a look at what else we're watching. And I am watching the economic data. We get ISM services for the month of September at 10 a.m., Danny. And what's really going to be interesting is because, of course, this comes just days before that crucial September payrolls report. So will it show a slowing because of issues on the labor side? Obviously, there are shortages, not just of energy, but of people. There's a real labor shortage out there. That results in higher pressure on the wage front. So what kind of impact will that have on activity in the services sector? That's what I'm really interested in this morning.
It is such a busy day for data. I have to say we got some PMIs out here in Europe as well. They didn't move the needle at all. Hopefully there's a little bit more excitement, maybe more optimism in those U.S. figures. Well, Kaylee, I am looking forward to Francine's panel that she gives at 1 p.m. Paris time, about 7 a.m. New York time, if I'm not mistaken. It is called High-Level Panel on Catalyzing Quality Infrastructure Investment to Build Back Better. Yes, that is a mouthful. She has a lot of interesting guests here, but the most interesting one, perhaps, is Secretary of State Antony Blinken. So a lot she's going to be able to discuss there, whether it comes to ESG, this idea of building back better, which I should say, of course, is a refrain we've heard the Biden administration use, and recently some tweets from Boris Johnson of him eating fish and chips and bread and butter. I don't think I'm British enough to understand what that is about, Kaylee.
Yeah, I'm nowhere near British enough for that, Danny. But it's interesting. I'm sure Francine will have some excellent questions for Secretary Blinken on foreign policy and geopolitics, but on building back better in infrastructure, we have to keep attention on domestic politics as well, because of course there is an ongoing debate about the future of President Biden's Build Back Better agenda and the trillions of dollars in economic spending he would like to see passed. There's that question and the debt ceiling question, and it's unclear if Senate Republicans are going to blink and allow the debt ceiling legislation Chuck Schumer is going to put to the floor in the Senate this week to sail through. And does that raise the risk of a default that the market is not yet appreciating, Danny?
Yeah, I would also say in terms of the debt ceiling, keep your eye on the demand for some of this short-term paper that, of course, would be breached or would be in trouble if we did breach the debt ceiling. Demand there, Kaylee, has indeed been slowing.
Yeah, and of course, you can track that on the Bloomberg terminal. More Bloomberg surveillance is ahead. We'll hear from Dr. Amish Adalja of Johns Hopkins, among others, including Megan Green of the Kroll Institute. This is Bloomberg.
China's growth because it is already slowing. Chinese manufacturers are curbing production. This is the latest shock to global supply chains, already delayed by, part delays, chip shortages, saddled with soaring commodity prices as well.
Well, Haslinda, when we've seen a lot of supply chain disruptions at the beginning of this COVID pandemic, and then, supply chains became resilient and it really moved goods around, especially medical goods and supplies. But now, at this part of the pandemic, we are seeing disruptions again, and discontinuities. And that is because of what we spoke about, the demand that is pent up. And of course, if you have factories slowing down and, not being able to produce as much, that is going to impact growth and the recovery.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
we've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
I support the new framework.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
What the Fed does is absolutely essential. It's been ignoring inflation all year.
I think it's pretty clear that inflation is going to remain elevated, and that'll be an issue.
For the economy, employment's all important, but for the markets, it's absolutely about earnings.
You have to still worry about the service sector. You have to still worry about all those areas that are connected to travel and to leisure.
It's hard to understand where we are now in the cycle.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Big tech on sale from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance live on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Your equity market futures bounced back at 0.4% on the S&P. TK, we need to discuss the damage at the index level and the damage done to big tech at the stock level.
You've got to partition it now. The index level, maybe not all that bad. It's down, but yeah, tech, there's some real damage as well. I'm going to call it on a moving average basis that I look back. You know what? We're back to support. Buy on the dip. I mean, where's the dip? We're going to find out this morning.
5% plus on the S&P 500, lower, Tom, off the highs. The moves on Apple, Facebook, Amazon. Apple down 11% from the highs. Amazon, Facebook, about 15% from the highs. Tom, they're real moves.
These are real moves, but John, I'm gonna tell this again. It's not percentage moves, it's standard deviation moves. But it's a bigger move. I'll go with that. But on a standard deviation basis, 11% on whichever big tech is contained. Again, it's sitting on one of the moving averages I look at.
The lazy justification I keep hearing, Lisa, is blame the bond market and higher rates. 2 Fridays ago, 145. Last Friday, about 145. 10s this morning, 149.
Oh my
There hasn't been a big move in the bond market over the last week to justify this gap low we've seen in the S&P 500 and for big tech for that matter as well. That in the last 24 hours has felt like a lazy story.
I would agree with that. I think it's also overly simplistic when they're unique stories for each of these. Apple, you're dealing with supply chain constraints, the fact that they're going to have delays on some of their Apple products. You have Facebook, of course, with the outage yesterday, and then Amazon with the pressures from increased wages for some of the workers. I mean, there are a whole host of different pressures. But my question is, how much, until you get this correction, that starts bleeding into sentiment around equities? In other words, at what point is this a buy the dip moment, and at what point does this feed into increasing pessimism against for investors?
I'm not talking about anything specifically here, but wasn't that a lovely 6 hours yesterday? Just nice, take a break. 6 hours, Tom. Did you enjoy that?
Yeah.
But I don't know, maybe correlation or
Facebook?
causation, Facebook, Instagram, WhatsApp down. You know, we could talk about it another time, perhaps.
It speaks volumes about our modern age. Also speaking volumes, John, is a headline that just broke. Let's go to that because it's germane to, John, how you open the show. PepsiCo, and this is the key phrase, organic revenue doing better than what was estimated. John, is this the beginning of what I've been talking about for 2 weeks, which everybody's focused on margins? You know what? If revenues pick up, that helps margins.
It is a beat and a raise over at PepsiCo, Tom. EPS coming in at 179, the estimate 174. Beat on revenue, beat on organic revenue. The raise, they now see full-year organic revenue, Lisa, plus 8%. They had seen plus 6%. I'll catch up with the CFO a little bit later this morning.
It really highlights how each company has a unique story. There's the Nikes, there's the Bed Bath & Beyond, and then there's Pepsi coming out and crushing it. And this is the question, is how do investors get ahead of this, and what is priced in terms of the expectation for beats versus misses?
And John, as you mentioned, Apple down 11%, Pepsi down roughly 5-6% in that same period.
I can't believe you didn't buy it on Facebook. Whatever. Futures up 17 on the S&P. I've given up on you, Tom. Forget it. Up 4/10 on the S&P. Let's move.
Job, and that's it.
Okay. 149.11.
I'm not focused, John.
I can tell. Yields up a basis point. In the FX market, euro dollar 116. We're negative there, a little more than 1/10%. Crude 77.84. Lisa, we approach a 78 handle on crude.
This, to me, is really significant. We're at the highest levels, at least on a closing basis for yesterday, since 2014. How much more do we have to go? And this really goes to some of the frictions in the markets that will be highlighted by today's economic data. Just want to swing through some of what we're expecting today. 8:30 a.m., we are going to be getting the trade deficit balance. It's near an all-time high in terms of a trade deficit. This comes as the U.S. still wants stuff, despite some of the anger at China, and they keep importing it, and the delays keep on increasing. Do we see an increasing deepening in this trade balance as we ramp up negotiations with China as to the relationship there? We also get ISM services sector data, how much the frictions in the labor market bleed into a weakening picture, which is what's expected for the services sector, albeit just slightly, still a recovery underway. Then at 10 a.m., talking about Facebook, Facebook's whistleblower, Frances Hogan, is planning to testify to a Senate subcommittee. Here's my question. Facebook shares up more than 50% year to date. Yeah, they've been sagging recently. Yeah, they had a bad day yesterday as the outages were pervasive and gave John Farrow a break. However, what is going to happen on a regulatory standpoint? We hear this again and again. Congress always has these hearings. They talk about regulating some big tech more. What action have we actually seen from them? And also, just to wrap it up, today we do have the first day of the Bloomberg Invest Conference. The key question here is, how do you invest at such a perilous time in terms of valuations and in terms of uncertainty, given the fact that you had, for example, over the past month, bonds and stocks selling off in tandem? This is a big question and conundrum, an opportunity for alternative investors who try to use this as a marketing tool. We hear from Greg Jensen of Bridgewater, Marcy Frost of CalPERS, and John Rogers, the famous investor from Ariel Investors. John, again, that big question of, is this an opportunity for them to get higher fees, or is this a risk because it's very hard to outperform in this kind of environment?
Lisa, thank you. What a lineup. Great lineup. Lisa, thank you very much. Tom, I figured out why you're distracted. Yankees.
Oh, did you?
At Red Sox,
yeah.
Fenway.
Well,
it makes sense now.
You're the only one on the planet, John, distracted by AC Milan and FC Porto to see what AC Milan will do there today. I mean, it's an incredibly important game. Not all that matters, John, is Bucky Dent is not playing. That's the only good sign the Red Sox have.
8:08, Tom, Eastern Time. Why does it start so late?
It's a stupid,
midnight,
don't
right?
get me going.
My whole plan today is to get you going.
No kidding.
It is the dumbest thing they are doing. I can't convey how stupid it is to have the important parts of the game on at 10:30, 11, and John, even midnight. Dumbest thing they do.
I agree. Let's get to the conversation this morning, Tom. Eric Robertson joins us now, Standard Chartered Global Head of Research from just outside of Sydney, Tom. I don't think he agrees. Eric, let's just start with this bond market. Your point, your message, the message from US yields does not entirely validate the renewed inflation risk narrative. Eric, can you start there? Build on that for us.
Yeah, sure. Good morning, everybody. Look, I think you highlighted it earlier. 10-year yields over the last couple of weeks have been remarkably stable, even with the increase in oil prices. And I think that tells us that it's not the long-term part of the yield curve that is potentially vulnerable. We've been arguing that short-term interest rates would need to go higher to reflect a higher probability of Fed rate hikes. And I think that's what's being reflected in terms of the cyclical narrative. You have not seen an increase in inflation expectations over the last few weeks, even with that increase in oil prices. And so in some ways, that's been extremely important to keeping long-term yields stable. But also, as you mentioned earlier, I don't think interest rates are the cause of the uncertainty or the risk in the equity market.
So there's a question of whether yields have it right or whether perhaps they're a little too sanguine in looking past some of the increase in oil, because it always has been a temporary move. There has been this sort of virtuous cycle for the oil bulls anyway, or the oil market, where basically production comes back online and then prices go back down. Is this time different, as we heard from Ed Yardeni yesterday?
Well, I don't know if I would say it's different. What I think is interesting is that in the first part of the year, when we had a big increase in interest rates, it was also happening at the same time as a big increase in commodity prices and the big increase in inflation expectations. So it was a very consistent correlation with the reflation narrative. What is happening this time is maybe a little bit more troubling, which is oil prices higher, long-term interest rates stable. Maybe it's saying to us that the increase in commodity prices generally might be a negative for consumer demand. And I think that's possibly what the equity market is sniffing out.
Eric, good morning. Standard Chartered Bank has a position in Southeast Asia. I love your slogan, here for good always. That speaks volumes about the Standard Chartered approach that you and Steve Englander have every day. I want to know if you can confirm the Asian bull case. We have selected guests saying, forget the gloom, and the bull market will be led out of Asia in a recovering China. Do you buy the thesis?
We like the Southeast Asian story, and in fact, actually large parts of Asia as well, Tom. Let me give you a couple of interesting examples. Even with the softness in economic momentum in China over the last couple of months, exports out of Korea, out of Indonesia, out of Singapore have been extremely resilient. And we talked about the U.S. trade deficit earlier. And this is even with a number of these economies still struggling to get out of lockdown. So I think a potentially underappreciated story for the rest of this year and into early next year is that economic recovery story in large parts of Asia outside of China.
Eric, do you see them moving away from this zero COVID elimination strategy? You're in Australia right now. Do you see them moving away from that?
Slowly is the honest answer. We've seen a number of countries and economies around the world move away from the COVID strategy. In Asia, it's been a little bit more hesitant. We've seen a few countries try and move in that direction. Singapore is moving in that direction. But let's be honest, there are a number of countries where their lockdowns are having a big impact on supply chains. Vietnam is a classic example. We think the economic growth potential in Vietnam is enormous, but the economic lockdowns that we're seeing at the moment are slowing or delaying that recovery.
Eric, great to catch up, sir. Eric Robertson there, Standard Chartered Global Head of Research. TK, what do you call Australia right now? The People's Republic of...
That's what you call it.
That's what I call it.
Yeah.
I thought that's what Tom called it.
No, I called it the People's... I got a surveillance correction, John.
No.
I called it the People's Republic of Massachusetts.
Oh, that's right. Of course. There we go. Just to clear that up.
The 7 Republicans in Everett emailed in and said it's the People's Republic of Cambridge. You got to go more narrow.
Thank you, Tom, for cleaning that up. We appreciate that.
It's not the People's Republic of
Look, on a serious note, on a very, very serious note, there is a zero COVID strategy in Australia, Tom. There is a COVID elimination strategy in Australia and elsewhere. Are they going to move away from that
New Zealand
next year?
New Zealand last night said yes, they are. Yes.
Will Australia follow in a big way?
Yeah.
Tom Keane, Lisa Abramis and Jonathan Ferro, or will the United States and the UK look more like Australia? Oh, you dread to think, don't you? Futures up 15 on the S&P, advancing a third of 1%. Yields up a basis point to 149. From New York City this morning, good morning. On radio, on TV, this is Bloomberg.
With the First One News, I'm Rishka Gupta. Facebook blames a global service outage on a problem with its network configuration. The issue took Facebook's core social network, its photo app, Instagram, and its WhatsApp and Messenger services offline for hours. It immobilized a suite of services that more than 2.7 billion people rely on to communicate, do business, and consume news. Meanwhile, a Facebook whistleblower is set to share what she calls the frightening truth with a Senate committee today. Frances Haugen plans to testify that the social network misled the public and shareholders about the harmful effects of its platforms. Haugen shared internal Facebook documents with the Securities and Exchange Commission. Democrats may have to live with a less generous expansion of the state and local tax deduction than they wanted. President Biden has conceded that lawmakers may have to scale back the cost of his economic agenda from $3.5 trillion to about $2 trillion. That means cutting the cost of nearly every program and tax credit, including the one for state and local taxes known as SALT. Russia's President Vladimir Putin has publicly dismissed climate change for years. Now he's prodding officials to take the threat it poses to the country's economy more seriously. The Kremlin is likely to come to the Glasgow Climate Summit next month with proposals to coordinate with Europe on carbon emissions. JP Morgan Chase is rolling out new measures to prevent coronavirus infections. The bank has banned business travel and on one-person meetings for employees who aren't vaccinated or won't disclose whether they've had their shots. Unvaccinated employees also will face higher payroll deductions to cover the cost of testing and health insurance. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
população é uma população importante, é uma população que frequenta a escola também, né? Então, é importante que eles também estejam protegidos para o coronavírus, evitando assim a transmissão.
Eu estava esperando muito por essa vacina. Desde o ano passado eu estava torcendo logo para poder minha vida logo voltar ao normal, que eu quero logo voltar para a escola, eu quero voltar a sair com meus amigos, eu quero sair, eu quero voltar à minha vida normal. A dose foi toda administrada.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
What have we learned from this evergreen crisis so far?
From my investment perspective, I think diversification is very important. So far this year, we see many events, right? Maybe in the fintech sector, and education, casino, and property. So I think diversification help you lower your risk on your overall portfolio.
Medium term, though, are you seeing more risk and reward in the high yield space in Asia? I mean, how are you viewing this right now? Are there actually buying opportunities given just the selling we've seen?
This time is a bit different in the property cycle because in the last, when you see there's a tightening measure, there's always demand there, right? Just the government trying to suppress the demand. But this time we're seeing a confidence issue, is like a buyer strike. Because of the sentiment, the evergreen is hurting the sentiment, and people don't want to buy. And other developer, because they want to get cash.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
The bottom line is this chamber must pass legislation to avoid a default. Accordingly, I will soon file cloture on the House-passed proposal that will suspend the debt limit until December of 2022.
Senate Majority Leader there, Chuck Schumer from New York City this morning. Good morning. Tom Keene, Lisa Bramett and Jonathan Ferro. This is Bloomberg Surveillance, and here's the price action. We advanced 16 points on the S&P, up by 0.4%. It is a little bounce on the S&P 500. We are down more than 5% from your previous high on the S&P. It's a drawdown, Tom. It's ugly out there. Yields are higher by a basis point on 10s to 149.28. Up a basis point, the FX market, euro weaker, 116.01. Tom Keene is quiet. He is distracted. He does not care about this market today.
Got that right.
He cares about one thing. It is Red Sox, Yankees. The Yankees go to Fenway, Tom.
This is your youth, folks. I mean, this is all there is to it, and to do this with Anne-Marie Horton is the way to do it. We've already had a surveillance correction this morning. Al from New Jersey, I don't know, not Boston, John, but Al from New Jersey comes in and he says it wasn't Bucky Den, it was Bucky F Den. I have no idea.
Have you ever worn that hat before?
Yes, I've worn
He wears that hat on the weekend.
Really?
Are you implying it doesn't fit, Lisa?
No, I'm just
implying that it doesn't fit on Tom's head.
On the
Carry on.
Yeah, on radio,
Red Sox,
you know,
carry
it's your
on.
standard Red Sox hat. We go to Anne-Marie Horton in Washington. We need to lecture. She's on an airplane tonight. What is that about, Anne-Marie? Let's go to the board and explain what matters today. This is Bill White on WPIX. This is the day, Anne-Marie. There's a day in your life, Anne-Marie, where you get older. This was it. Deep to left, Yastrzemski, the older, will not get it. It's a home run, a 3-run home run for Bucky F. Dent, and the Yankees now lead it by a score of 3-2. Anne-Marie, what do you see tonight?
I think it's who has the edge with the pitchers, Tom. Also, I cannot take you seriously with this hat on. I will be flying, but I'm going to be wearing my Ralph Lauren Yankees collab jacket just to bring all the energy to Fenway. And I think it's Garrett Cole's going to be starting. And he didn't have a great August, a solid September. And Gio Urshela, did you see that play when he ran into the dugout? He was injured after that, and he's going to be playing as well. So I'm confident.
Am I meant to pivot to something serious off the back of this? Because I can't take Tom seriously either. Tom, is that staying on?
Staying on until they win.
Until they win.
Show.
It could be a while, Tom, if they lose later. Going to wear that for like the next year.
It is, for those worldwide, it goes back to 1967, John. All of my youth, the Red Sox always lost.
I appreciate the romance of the moment, Tom.
Yes.
I'll tune in for the first pitch.
Talk to Anne-Marie about Washington.
I plan to do that, Tom. What a shocker. Thanks for the suggestion to speak to the Washington correspondent about Washington. Anne-Marie, a press conference from the president in the last 24 hours. He is singing from the same script repeatedly. Are the Republicans listening?
They're not. They're not at all. Senator Mitch McConnell actually sent a letter prior to that speech from the president, and it's just game theory in Washington regarding the debt ceiling. It's the same place we have been. What's nerve-wracking is that if the Democrats were to be the ones to blink, and they have to go through this reconciliation process, they have now 13 days to do so to meet Secretary Yellen's ex-date of October 18th. So that is what is so scary right now. Senator Schumer invoked cloture, potentially bringing that bill from the House on the floor. The problem is it doesn't have the Republican votes to do anything with it.
So yesterday, Wendy Schiller came on this show, and she had a really great point. Tell me one detail from this program other than we're going to help children, we're going to help families, we're going to help provide health care. What are the details that they're haggling over? Can we get our hands around some of the meat here?
It's a great question. It's hard to think about exactly what the details are or the timeline because they are still negotiating what is going to be acceptable on the top line. The president met with progressives yesterday in a virtual meeting, and what we learned is that top line is going to be anywhere between 1.9, potentially 2.2, $2.5 trillion. And then you start filling it in. So potentially it could be child tax credits, universal pre-K, and what they might do is just shorten the timeline. So under reconciliation, you actually can't even have a budget that goes past 10 years anyway. Potentially some of these will go to 5 years. The other big initiatives are climate change. There were a number of climate initiatives to boost the grid, to move towards a greener infrastructure in the hard infrastructure package, but still billions of dollars not included in that they also wanted to include in reconciliation. And I feel like once they get this top line figure, then they'll be haggling over who gets what, because this is only the very beginning. You have Senator Joe Manchin from West Virginia. He wants subsidies to continue for fossil fuel companies. Then you have Kirsten Sinema of Arizona, who was a Green Party candidate. She's going to want to push for climate initiatives. These are two key people. Once they decide on the top line, there's going to be a ton of dispute about what goes in.
What's the timeline here, Anne-Marie?
It's a great question. Speaker Pelosi says October 31st. So Halloween is when she wants to again try and bring hard infrastructure to the floor. And now that we know it is linked to reconciliation, that's the timeline to get both those packages done. So you're looking at the month.
Timelines and deadlines in Washington. AMH down in D.C. Anne-Marie,
I was triggering him, by the way.
I know you were.
I love it.
I'm letting it slide. Anne-Marie Horden, a Bloomberg Washington correspondent. Not really, at all. Lisa, month end, is that really it? You're not convinced, are you?
No. I mean, look, what Anne-Marie was just saying is so important. They're trying to get the top line number done, and then they're going to fill in the details. The details are actually the important thing, the substance, right? The thing that they can actually go and try to sell. And the fact, I keep going back to what Wendy Schiller was saying, where it's basically almost political malpractice to not talk about the details that a lot of people agree upon because those details are controversial within the same party, let alone the actual top line number. I mean, can you actually create something concrete with this by the end of this month? Can you imagine that, John?
I don't know. Question from Mohammed. Tom Keane, great cap. Good feedback. Will you be able to tell us about the 1986 World Series, please?
Let me tell you about it.
Oh,
the
boy.
only time, John, in my modern life I have asked for an autograph was at the third base dugout of Fenway Park for Game 3 of '86. I was standing with the spectacular Roger Angel, who is still with us, very elderly, near 100, maybe 97 years old. Oil Can Boyd came in, John. You could see his knees were shaking. The ball went into home plate. Lenny Dykstra hit the ball. It went over Everett. It's rumored. It's never landed, John. They lost sight of the ball in the vicinity of Nova Scotia. That ball was hit so hard. And Lisa, the Mets...
Yeah, all of this is a big build-up. The Mets won.
Is that the last time the
That's
Mets
literally
won?
what that
Is
whole
the last
thing
time
was.
it happened, Lisa? Was it
The Mets
1980? Has it
won.
happened since?
Yes, I think so.
You think? Do you want to check that?
I will. Yeah,
Aren't you guys meant to know this stuff?
Yeah, I try to blank it out. All right, moving on.
You
Look at
wanna
those markets.
Okay, look at them.
They're
Just for
doing
you, I'm
actually
going to let you get
dreadful.
away with that, all right?
Thanks.
Futures up
You're so
16.
kind.
Just so you know,
4/10 on the S&P.
Lisa asked what the timeline was. The timeline is the Red Sox have to get to the fifth inning.
Are you seriously wearing that cap for the whole show?
I slept with it last night. Why not just keep it going?
Okay, yields up a basis point, 149.28. You can write in and vote whether you think TK should keep that cap on for the whole show. Up 16 on the S&P, we advance 0.4 of 1%.
Idea, John.
It's a bounce.
It's
a
a
bounce in the
British
equity
thing.
market.
It's like John Kelvin
Just
in
trying to do the
Switzerland.
markets top.
1986 was the last time, by the way.
I can see how the show's going to go today. Okay, Tom Keene, Lisa Bramett and Jonathan Ferro. This is Bloomberg.